I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2%.
The higher for longer is going to stay there.
Above all, the Fed understands that reestablishing price stability is key. They're not giving up the 2% inflation target.
The economy is doing fine, and I think inflation is on its way to 2% by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance coming into Thursday at all-time highs on the S&P 500 and the Nasdaq 100. You've had the data. Here comes the Fed speak. This is the lineup. Barr, Barkin, Harker, Mester, Bostic, all on deck today, Lisa, following that softer than expected headline inflation read.
Is there anything they could say that matters? And I say this because so far we've heard basically hawkish light speak, even from Jay Powell, basically saying that it hasn't come down as quickly as we'd like. And the market said, we don't believe you. We don't care. Right now, even a 0.1% sort of miss in terms of CPI is enough to bring back the prospect of a September rate cut and then another one in December.
The future's positive this morning by 0.2% on the Nasdaq. We're up a tenth on the S&P 500. The rate cut talk simmers into the summer. I'll go through the calendar briefly for you. We get another read on CPI the same day as the next Fed decision, June 12th. You'll get another read on July ahead of the Fed decision at the end of July. Is that enough time to have this conversation about a rate cut later this summer?
Well, it's not for Neil Kashkari, who already heard from yesterday. And his quote was, it's unknown in terms of how much downward pressure there is on the economy. And that tells me probably we need to sit here for a while longer. And he was talking about maybe we only have 1 foot on the brakes and not 2.
All I could say is this is a market that wants to rally. Period, full stop. I mean, basically, it was the downside was, it would kind of stay flat. The upside was to the moon. We heard from Eddie Ardeni yesterday saying 6,000. At what point is the Fed just sort of getting away from the narrative? And basically, at this point, the weakness is being dismissed. Disinflation is sort of baked in. And it doesn't matter what Fed officials say. I think the key question is going to be, how much is this market rally dependent on Fed rate cuts at all versus just simply not a reacceleration of inflation?
It's a question we've asked repeatedly on this program. The Fed chair has retained this bias to cut interest rates regardless of what happens with the economic data. He still retains that bias. The question we've all got now, was the head fake yesterday or was the head fake Q1 inflation data? We can have that conversation through this morning. It's not just about inflation, it's about retail sales as well. They're coming in just a little bit softer than expected. In about 50 minutes' time, an hour's time, we'll get numbers from Walmart.
I'm looking forward to those because we are seeing this weakness in the retail sales number, but also in consumer sentiment. Home Depot was also a little bit softer. You see people are starting to defer some of the big projects they want to take on. What are everyday Americans buying and what are they not? And are they stopping for some of these mass big ticket items?
Walmart right now positive by 0.8%. I've mentioned some dates for the diary. 2 more. June 27th, CNN. September 10th, ABC. Did we just agree to some debates?
They did agree to debates. This is outside the presidential commission. They're going to go right to the networks. I have to say, though, when I put it out on Twitter, some people said, I take the under on this. There are people who are still skeptical that Joe Biden and Donald Trump will show up. But right now, it is slated for the end of June for CNN in Georgia.
Team Biden. Any time, any place, but not under just any conditions. Apparently no audience, and they want the option to cut off microphones as well.
Okay. I think that that's the point of the skeptical, the people who don't think it's actually going to happen. And then there's a question of what happens to the traditional way that debates are established. And then, of course, there's Trump, who says there's one from Fox News, and Biden saying, we don't know about that one. So TBD, that's all I can say.
Any time, any place, but with conditions. Equity futures right now on the S&P. Here are the scores. Positive by 0.1% on the S&P 500. Yields are just about lower by a single basis point. 4.3322. What a turnaround in the bond market over the last month or so. And the euro, just a little bit of weakness after a day of strength against a weaker dollar. Euro dollar 108.70 was softer by 0.1%. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore as equities rally to all-time highs. Kit Juckes of Soc Gen as rate cut bets rise on cooling data. And Bloomberg's George Ferguson as the DOJ moves a criminal prosecution of Boeing. We begin with our top story, slowing inflation fueling a record-breaking rally. Julian Emanuel of Evercore saying this, our base case remains an ongoing correction which ultimately tests the S&P 500. The potential for further near-term upside cannot be eliminated given that economic surprises lie at almost the exact intersection of Goldilocks and too cold. Julian joins us now for more. Julian, good morning to you.
Good morning.
Let's start with the data yesterday. What did you make of that?
look, clearly the market liked it. Okay, that tenth of a tick lower in the monthly number was certainly celebrated. But then you look at the retail sales, again, that's the intersection of Goldilocks and too cold. And if you stripped out gasoline, the number would be even weaker than the headline zero. So for us, look, the ebullience around the Fed's activity or lack of activity or wherever their path is leading has certainly driven the animal spirits higher. But for us, the bottom line is 3.4% CPI, 0% retail sales, other signs of economic weakening. That doesn't say that the upside is unlimited as the market is trying to behave.
Is this a record high you want to sell?
We want to be tempered about it. Look, what I'd say is this. Again, when you're facing a momentum market, the likes of which we have, to say that momentum is going to stop on a dime is a very difficult call. We do think, though, that this is one of these times. Think about the beginning of March. Think about last summer when all of the news feels as if nothing can go wrong. That's probably the time to do a little bit of hedging.
Which would have been 6 months ago, which probably would have been a while back, as people basically were saying, well, things seem like they're priced to perfection. What gets us to 47.50, which is your projection about a month ago?
Frankly, it is, again, this intersection of inflation staying stubbornly sticky. And if you think about the months coming up, it's not likely the readings are going to get a lot better, which is, I think, why you've seen, and you will probably see today, the Fed governors come out and talk about counseling patience here. And frankly, when you think about it, the equity market is now sort of working in their favor to promote the narrative of patience. At the same time, again, the monetary policy of the last 2 years is finally starting to kick in and slow the economy.
You said that the equity market is promoting the narrative. Some people might disagree and say it's actually moving in the opposite direction, and it's promoting the idea that actually things are going great. And, if financial conditions matter, could reaccelerate inflation on the other end. Why do you disagree?
Well, so, again, this is the fine line, right? We're going to have annual comps in the next few months that will make it seem as if inflation is sticky. Ultimately, the longer-term course is the same course that we've been on for the last year, and that is lower inflation. And frankly, that is part of the benefit of the slowing economy. But it's sort of it's a gradual process, and I think the market is a bit too overenthusiastic about the fact that this is the path to success without bumps.
But you do think inflation is coming down, but you say September, December, those rate cuts are not guaranteed. Where's your thinking now in terms of rate cuts?
So our base case is that they do go twice, but it's a very fine line at this point. If the data does, as we think it could, prove sticky, they're going to have to reconsider. And I think that's why you're seeing the narrative come out the way it is. And so given the political schedule, it may end up being no cuts this year.
So record highs on the NASDAQ, record highs on the S&P 500, small caps participating, and we're all trying to work out what to buy. What do we do now?
We think the case for small caps is very interesting.
Why?
Okay. Number one, it's one of those things, and we've seen this time and again throughout the last decade or two, when the enthusiasm around large cap tech gets the way it is, and next week will be an interesting data point to test that enthusiasm when we get the Stars earnings reported. The discount is extreme. The seasonality around the Russell indices rebalance is very reliable. And the sentiment, small caps have been the funding short for active managers for almost 2 years now.
New York Fed President William speaking right now to Reuters. April CPI, a positive development, says that policy is restrictive and in a good place. We've heard that a few times. You just said maybe no cuts this year, and then straight afterwards said buy small caps. What's the relationship between the two? Because a lot of people might say you need one to get the other.
Well, interestingly enough, if you actually don't cut this year, you may, in fact, hold longer-term yields in check by remaining with that degree of discipline. And frankly, when you think about stocks in general, they're much more sensitive to longer-term yields in terms of discount.
How much is some of the confusion just a valuation story? That essentially it's hard to make an argument based on what you just said for small caps. If you see inflation, sort of a question of where we are between this Goldilocks and something that's more pernicious in terms of a hard landing. You're not sure what's going to happen with Fed rate cuts. Is your case for small caps a valuation one, and your case against large caps also a valuation one?
Well, valuation is probably more important than it has been, and quite frankly, it's uncomfortable for us to talk about valuation. But when you get to these kinds of extremes, and they're not extreme, for instance, in Y2K, you got to 28 times, which is 6,300. We don't think that's the case this time. But it is, one needs to stick to one's discipline and realize that, nothing tends to last forever when you get to these type of extremes.
We were talking with Edgar Denny yesterday, and he said there's clearly a broadening out. And you can see it not just with small caps, but you can see it also with this idea that now everything is an AI play. Utilities are an AI play. How much do you sort of buy into that and ride the sort of morphing wave that's shifting from industry to industry as everyone understands some of the efficiencies that can take place?
Well, so again, the comparisons with the internet in the 90s are apt. But, we recall that to get to full internet adoption over the course of the last 20 years, you had several recessions, you had several bear markets. It's not a smooth line function. And we do think that the potential for AI to secularly improve productivity across the entirety of corporate America is there.
Julian, we'll get a bonus round with you. You're going to be sticking with us. Kit Juckes joining us as well in just a moment. Kit Juckes of Soc Gen with this morning. Yesterday's CPI data highlight the market's lack of conviction and tendency to be led, if not by the nose, then by each of the major data points. That makes for choppy markets, but not trending ones. He goes on to say, leaves anyone trying to overinterpret data in danger of being fooled by random short-term surprises. You wonder how quickly this conversation can change from data point to data point. Kit Juckes just around the corner. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Slovakia's Prime Minister Robert Fico suffered life-threatening injuries after being shot in public. It's the first assassination attempt on a European leader in more than 2 decades. The 59-year-old was admitted to the hospital in very serious conditions. The police say that the gunman had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. Chinese President Xi Jinping affirmed that the relationship with Russia remains strong. He told Vladimir Putin that the ties between the two nations should last for generations. Putin's trip to Beijing is his first foreign visit since he started his 5th presidential term. As Russia intensifies its war against Ukraine, Putin described the ties with China as, quote, one of the main stabilizing factors in the international arena. U.S. CPI data was accidentally published 30 minutes early yesterday. There was no obvious sign that the early publication moved markets, but the Bureau of Labor Statistics said it is launching a full investigation. This isn't the first time that BLS data practices have come under scrutiny. A month ago, Bloomberg reported that a BLS economist corresponded about CPI's components, answering numerous questions in detail with major Wall Street firms, including JPMorgan and BlackRock. That's your Bloomberg Brief. John.
Danny, thank you. I mean, it goes without saying that that's a problem, Bramo. We were joking about it maybe leaking a day earlier, but apparently it was 30 minutes earlier.
I'm just thinking to myself, darn, why didn't I look at the website earlier? Why did no one catch this? I mean, come on.
Nuts.
Right?
Because we're all staring at the Bloomberg terminal, waiting for the proper time at 8:30 Eastern when it should come out, doing the right thing. Up next on the programme, the Fed sitting tight.
We probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
That conversation just around the corner. You'll hear more from Julian in just a moment, and Kit Juckes of Soc Gen on the other side. Live from New York City this morning. Good morning. Equities on the S&P 500 just about unchanged. Live from New York, good morning and welcome to the programme. Yields are going nowhere on a 10-year, 433.42. Under surveillance this morning, the Fed sitting tight.
How much downward pressure is monetary policy putting on the economy. That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So here's the latest. Minneapolis Fed President Neil Kashkari repeating that the Fed is likely to hold rates steady for a while longer as investors bring forward rate cut bets. The Bloomberg dollar index falling to a one-month low, with treasuries mostly adding to their advance following CPI data. Kit Juckes of Soc Gen joined us now for more. Kit, you wrote about it this morning. We're at the mercy, seemingly, of the next data point. There seems to be no trend. Is that what you're advocating to clients this morning? Don't get too excited about yesterday. It could change next month and the month after again.
Yes, definitely in the short run. Look, the Fed is clearly data watching too, so the markets have no reason to do much that's different in the short run. I think we probably learned, if we're close to learning, that the next move the Fed will make will be a cut, not a hike, unless it's in years down the road. So the upside for the dollar is somewhat capped by that. But, we've had 3 low 0.4 CPI monthly prints followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. We've got an election coming. I think the market is going to be just waiting for the next data point before it does anything else. And yeah, we look as if we might have defined a fairly narrow range for the dollar to trade in.
It's been truly exciting, though, Kit. For the past year, it's been just absolute fireworks in the euro-dollar cross, and we talk about it every single day. Are you basically just explaining why we're not moving out of this anytime soon? Or are you saying that it needs to be an even tighter range, that people are going to get really their faces blown off if they try to do something that is more bold?
In my mind, euro-dollar is in a 106, 110 range for as far as I can see. With any great confidence, and I think it goes a bit higher in next year. It's almost that bad. Look, the politics will move that range around quite a lot as we get through the fall, obviously. But yeah, the really surprising thing, in a sense, is that after all the shocks we've had from the macro events, the geopolitical events since the beginning of 2020, that the U.S. economy is having a gossamer soft landing, which I wouldn't have believed possible. No one did that on the Hudson. And we're settling down and just really saying, OK, so what happens next? We're not sure.
There's a question about the European side of things as well, given the fact that we saw a number of GDP prints come in stronger than expected. You do see industrial strength returning to certain regions. I see you kind of going like this. Maybe it's from a very low base, but how much is that something that could drive a bit of strength as well? It's not just the U.S. side, it's also what's going on over in Europe.
It's not irrelevant. We'd got to the point where the markets were so pessimistic about Europe that it was almost impossible to think which piece of European news would be bad enough to make things worse. Now I think we're moving to a point where instead of stagnation, we've got slow growth. And I think the most growth-sensitive currencies, for example, the Norwegian krona particularly, maybe stands out in Europe. Maybe they have room to have a bit of a rally just because they have a bit of leverage on that recovery and sentiment. The key for Europe will be the German economy, because clearly the situation in Ukraine, clearly Germany's reluctance on gas, natural gas, and clearly its heavy industries and its trade position with China are all sort of fairly serious issues in the long term, not just now. But I've said it often enough in my mind about sterling. When all the news is nothing but bad, it doesn't take much for a currency to go up on the back of slightly better news.
Kit, question. The narrative has been that the ECB has been able to sort of give out this declaration of independence from the Fed in terms of its own rate-cutting cycle. Is there a price on euro-dollar where that declaration of independence has to be amended?
I'm not sure. Not necessarily. It's certainly the Declaration of Independence. Maybe if we got back under the 2022 low at 95, 0.95. But remember, we only got there on the back of the biggest terms of trade shock in favor of the dollar and negative for the euro since any of us were born. So that's quite a long way away from here now, but also quite a long way away in terms of what the situation is. I think it's quite solid. Where it gets tested, I think, is by the Fed hiking while the ECB's easing. So if the Fed were to raise rates twice and the ECB were to cut rates twice at roughly the same time, I think, I think I'd go and hide under the sofa over some of the behind the sofa for some of the data points. But I don't think that it's written in stone. They have to move, step for step. And you can see by the yen, you can have quite big currency moves that don't have a major impact on the economy. I mean, the Japanese are not getting the kind of economic recovery you'd like to see from an economy whose currency has just lost that much of its value.
Yeah, we all noticed the Ministry of Finance in Japan popping its head back over the sofa, Kit, yesterday. It could look better news for the Japanese. Is the worst over for them in the FX market?
I know, tell me if we've seen the high and 10-year note yields is almost the answer to that, because that's what the yen's following. It doesn't feel to me, we're probably one solid US data print, two from a rise in US yields that gets us to 160 again. The people who've been selling the yen have been earning carry the whole time. They might have given back some of their profits, but every day they pick up more money from the carry of that trade. Volatility's coming back down, so owning trades is getting less expensive. So they're getting a period of calm, but you wouldn't declare the whole fight over yet. The basic driver, that huge interest rate differential, has not gone away.
Kit, I'm thinking of you going into the weekend as an Arsenal fan. Good luck, sir. Kit Juckes of Soc Gen out of London. Thank you very much. Tough couple of days for Arsenal fans, given what Tottenham couldn't do, but we knew that would happen, didn't we? Let's get some numbers from Deere. They've cut their outlook for profit. New numbers for you. They now see full year net at about $7 billion US, the previous range, 7.5 to 7.75. Lisa, the stock is down by close to 6% in early trading.
They explain the why, and that's basically that farm income has been easing, in part because prices have been coming down. This is the flip side to disinflation, or in some cases, outright deflation. It actually has been a driver of earnings. The idea that we've got inflation and disinflation or deflation isn't exactly the panacea for some of these industries that people were thinking.
Julian, what's your reaction to this one?
Well, the agricultural income definitely has been under pressure, and it's not a story that's well understood when you think of, the price of cocoa, for example, in recent months. But wheat prices have really been in a downtrend for months on months, and our industrials analyst thinks that that ag cycle has to work its way through. We have a bit more cautious view on that sector.
The idea here that the shares are lower by 6% also tells you something in terms of the reaction function that we've seen so far this year. Any misses have been punished, and that we've talked about that extensively on this show. Are we reaching the end of that? We're pricing in a more potential weakness, and we're not going to see this kind of massive reaction, or is this the new normal?
Well, actually, and if you look at it, this is now the second quarter running, and we would expect that to happen next quarter as well, because the stock market has been a market of stocks and not a stock market, very uncorrelated. You're going to have these individual reactions in extreme, and it's less about, if you get misses like this, you're definitely going to get that kind of reaction, but a lot of it is positioning.
Julian, just before you go, in about 35 minutes we'll get Walmart. You don't do single names on TV, I understand that. What would you look for from a name like that when they report?
It's really a generalized state of the consumer, and is there any pressure that they're seeing on the low-end consumer, because that's where all the stress has been noted in recent weeks.
Those numbers about 35 minutes away. Julian, always a pleasure. Privilege, sir. Thank you. Julian Emanuel there of Evercore. Let's turn back to Deere. New outlook for full-year profit. The net at about $7 billion US dollars. The previous range, 7.5 to 7.75. That stock is down by close to 6%. The commentary from the CEO, here's the quote this morning: "We are proactively managing our production and inventory levels to adapt to demand changes and position the business for the future." That stock is negative in early trading. Coming up on this programme, we'll talk about a stock that's been negative for most of this year. Bloomberg's George Ferguson on the possible criminal prosecution of Boeing. That conversation is just around the corner. Walmart numbers not too far behind, 34 minutes away, with equity futures just about positive on the S&P 500, coming into Thursday at record highs. Live from New York, welcome to the programme. Equity futures on the S&P 500 just about positive. All-time highs yesterday at the close on both the S&P and the Nasdaq 100 for the first time since March. On the Nasdaq, 5-day winning streak coming into this morning through yesterday. We're positive again. We had some more weight to that rally, up a little more than 0.1%. If you switch at the board and get to the bond market, what a turnaround we've seen in treasuries. Think about where we were at the front end of the yield curve to close out April, north of 5% and all the way back down to 473.82, up a single basis point this morning on twos, on a 10-year going nowhere. Lisa, 433.80.
Yeah, but 10 basis points on a 0.1% downside miss yesterday. I have to say, I read note after note, and they all had completely different interpretations, talking about the Rorschach test of 2024. Basically, RBC coming out and saying they still think that it's going to begin in December. Mizuho says, just wait a second, because we think that actually we've seen a stalling out here at 3%. Everyone has a different take and an interpretation, so welcome to the market in 2024.
Those takes didn't change yesterday.
Exactly.
There was nothing about yesterday that changes the base case, which for equity markets, I guess, is good news. It doesn't get any worse.
Everything is good news for the equity markets right now, because you're talking about hitting that sweet spot. Kit Juckes was talking about that perfect nirvana that he had discounted as well. That seems to be the reality.
Let's turn the board and get to the US dollar against the euro. The dollar index, DXY, having its worst day of the year so far in yesterday's session. Against the euro, we are negative by about 0.1%. That's in the dollar's favour. Yesterday, the dollar weaker against absolutely everything in G10. The euro, Lisa, getting close to 109.
Yeah, although Kit Juckes pouring any cold water on the idea of some sort of narrative shift where suddenly we're in this sort of weakening dollar trend, just saying we're still caught in this range. Unclear how much you can really derive from this, but there has been a broader story about exceptionalism broadening out. And a lot of that is pegged to the fact that the U.S. is not alone with industrial policy anymore and investments. That's creeping to outside of the country. That's what I'm watching.
Kit Juckes, the Soc Gen, I think put it perfectly, as he often does in his morning note. We're at the mercy of the next economic data point. As the narrative just gets whipsawed from one end to the next. Anyone can try to overinterpret the data. They're in danger of being fooled by random short-term surprises. There is no strategic anchor coming from the Federal Reserve. This is what Mohamed El-Erian has warned about repeatedly, and for that reason, we just swing from one data point to the next, from 7 cuts to 1, back up to 2, and who knows when that's going to start.
So tune in as we overanalyze every single data point that comes out, because ultimately people have nothing else to go on. Each company is a different story, and that's part of the problem. Is that, okay, do we go to Deere and this idea of agriculture demand, or do we go to Walmart and see what they say about the broader economic outlook? What's going to be the next one that really gives that overview that we used to get?
Jobless claims in 2 hours' time. We'll do it all over again at 8:30 Eastern time after that rare upside surprise in the previous week. We'll see if that comes back down. And if it doesn't, if it inflects even higher, then we'll get even more worried about the prospect of the economy turning over, and maybe we go from Goldilocks to being too cold, which is what Julian Emanuel of Evercore is talking about. It's exhausting, isn't it? You're not alone. Under surveillance this morning, slowing inflation, boosting bets for 2 rate cuts this year. Investors looking ahead to labour market data with jobless claims in about 2 hours' time. Plus a host of Fed speak with Barr, Barkin, Harker, Mester and Bostic all on deck a little bit later today. Elsewhere, President Biden and former President Trump agreeing to at least 2 debates this election season. The first matchup coming June 27th on CNN, then September 10th on ABC. The debates will not be sponsored by the nonpartisan commission that has organised these events, Annmarie, for decades.
Yeah, 37 years, but this was a long time coming. Remember in 2022, the RNC said they're leaving the commission. They didn't like the way it was performing. Now, the Biden camp is saying also, we're not exactly happy with some of the rules and way the commission works. So the commission has become pretty much obsolete. Although the commission, though, put out a statement and said, we will prepare for the debates if you guys decide you want to show up. And they're usually held at universities. Usually there's a live audience. That's something that is not going to happen at that first CNN debate in June.
Can we talk about the importance of June, why it is in June, why we are going earlier, and why Team Biden wants to make this happen in a big way?
I think one thing is that they see how dismal the poll numbers have been for the Biden camp. So the idea is to get a boost potentially. Remember, Biden in our polls got a boost after the State of the Union. He had a pretty strong performance. Some would say the bar was very low, but he had a pretty strong performance, and then he got a boost in the polls. Potentially, he could do that in the debate and bring back the former president and some of the rhetoric that doesn't bode well with some swing state voters and some independents, bring that back into the living rooms of the American people.
Can I just say the fact that while the former president sits in a courtroom, his poll numbers are going up, that basically we're at a place where one person is trying to message and give a sense of what's going on and, play all these different angles. Then you have one president sitting in a courtroom listening about a hush money trial. It's just sort of, state of play in America 2024.
Inflation, and what you continuously see in poll after poll, even though the Biden camp says, don't look into the polls too much, it is still early in the timeline to November, but inflation remains the #1 issue. And when you ask respondents, who do you trust more in the economy? Continuously, they trust the former president.
So I'd say a couple of things. Number one, I mean, yes, he's in court, but that's part of the campaign. And it's working in his favour.
Exactly.
Big time.
That's my point.
The second thing I'd say about the Biden move, Biden did very well. And he won an election, not as the incumbent and making it a referendum on the other guy. He was able to do that because we were in a pandemic and he could hide away and just leave the spotlight on Donald Trump as everyone was suffering at home and then go to the polls later on that year in November. He can't do that this time around. He is the incumbent now. And the referendum is on him in many ways. And I'm not sure how they turn that round strategically, because at the moment they seem to be struggling with it.
And he has to be in front of the cameras. We saw him this week give an interview to Yahoo Finance, but it was about 3 minutes long. I think Brian Sazi, who did a good job asking about the tariffs and stuff, but he only got a short amount of time. Is Biden going to sit down for longer extended interviews that would be normal in election year?
We'll talk more about this a little bit later. Usually in debates like this is to get to know the candidate, right? I can't think of two candidates that are more well-known than these two. Going back decades,
Almost
can you?
too much TMI.
Well,
Really?
What's the purpose? I mean, is it going to basically be a mudslinging match and who can sort of withstand it better, or sort of the carriage in terms of the attitude?
I think the purpose is quite clear. This is about early voting, which is why Team Biden wants to go early. They want this done in June because they know that people are going to make their mind up pretty soon. There is this belief in the Biden camp that there are a bunch of people that haven't really connected with the election just yet. And when they do, they'll lean towards him. This is why I think the June debate is going to be a big test of that theory. Do we actually get that bump in the days and weeks afterwards?
Also, potentially, it could be a huge bump for the former president. To Lisa's point, he's been in court every day. Yes, most network media has been wall to wall following his court trial, but this is a way for him to actually talk about something else other than his hush money trial.
We'll talk more about this a little bit later this morning. Let's turn to this story. Boeing facing a possible criminal prosecution. The Department of Justice says the plane maker violated a deferred prosecution agreement tied to two fatal crashes of the 737 MAX. Boeing has 4 weeks to respond before the DOJ decides how to move forward. George Ferguson of Bloomberg Intelligence joins us now for more. George, this is a company that's really, really struggling. Can you talk to us about what is at stake now and what kind of fines we could see come from the US government?
Yeah, so my sense is that this is not going to be about the money, the fine money. My sense is that this is really about the DOJ holding Boeing accountable for what they promised to do, which is just put in better oversight, better compliance measures. I think they have to be very careful here, right? Because Boeing is a very important component of the U.S. economy and the U.S. defense establishment. I would say that, the company is already hurt financially. We saw them go into the financial markets, the bond markets, a couple of weeks ago for about $10 billion to shore up cash. As you know, they burned a lot of it in 1Q, and so they needed another $10 billion. They really need the turnaround to happen in the second half of this year to start to generate cash, or at least really minimize the burn, for the company to stay on stable financial footing. So again, I would go back to, I think they have to be careful about any fine levels that they would impose. And it's really about holding their feet to the fire on this compliance, internal controls, just keeping the spotlight on that for Boeing so they fix that and become a better manufacturer.
George, isn't that actually really difficult to do, to simultaneously acknowledge that Boeing is a special case and then at the same time hold the company's feet to the fire?
I think it is. Agreed. It's challenging, but I guess maybe it means you can't do it so much with money, but you'll have to use other levers like getting inside the company, increasing your oversight of the company to do it.
George, can you think of another company that is in this spot of too big to fail, too important to fail in the U.S. industrial complex?
I think there are a number of companies I think that the administration would think is too big to fail. And the reason I use the word administration is I would just go back to, like, if you remember the General Motors bankruptcy, right? I think the Obama administration realized that company was too big to fail. They couldn't let all those jobs go away. Another super important American manufacturer, and they changed rules to make sure they had shepherded GM through some of its problems. There are, I think, a lot of companies like that we would look at in the economy that are too big to fail.
This raises a question, George, especially as we shift toward a much more industrial policy type of framework, a sort of central planning type of framework, with investments in other companies similarly to try to build up other infrastructure. Just focusing on Boeing, how much are we looking at that as being one reason why some of these issues with safety and speaking up and all of these other training programs have been able to be ineffective for as long as they have?
Boeing, I think I follow sort of where you're going with that question. I'm not totally sure I get it, but, actually, maybe you could rephrase it. So I don't totally get that. Sorry.
Okay. Well, I guess that what I'm trying to figure out is this a case of Boeing not necessarily having the oversight? And the reason why some of the issues that keep on dogging them, this was an issue going back to 2009. Then in January, there was the panel issue. How much does this stem from a lack of oversight, a lack of discipline that has not been implemented on this company?
Sorry, I'm smiling because I apologize for not getting in the beginning. So look, I think what's really challenging about Boeing is they're the only commercial aircraft manufacturer in the country. So when their regulators approach them and try to oversee them, the people inside Boeing are typically the smartest in the room, and that makes it really difficult, I think, to put effective oversight into the company. And I think we've seen that's been part of this, breakdown we've seen over the last number of years, where the FAA hasn't been deep enough into their processes to tell whether or not they're doing a good job or not, right? And so part of this story is probably going to be the FAA reauthorization, them adding a bunch of money into budgets at the FAA, focusing more on oversight of these manufacturers. Because, again, I think the manufacturers, and especially Boeing, knew the most about the business, and there was no one outside there that could really put a good critique on the company.
George, I wonder if it can be the shareholders. What are you expecting from them in the next 24 hours?
I think it's very difficult for the shareholders to put proper oversight on the company. Again, it's such a, it's a very technical business. It's an important engineering business. I think the average shareholder, especially the ones with the big blocks of votes, don't know enough about it to put pressure on it. But I think they do understand when it's not working. It isn't working now. And the pressure will be on the management team. Challenge here is finding the new management team, finding people they think are good manufacturers, people that can set up good systems inside, and getting them on board. So right now, can't even apply much pressure to the management team because it's on its way out.
Yeah, the only name we've heard is sort of Larry Culp doing the rounds over the last few weeks. Yeah. Very, very little news on who might be taking that role. George, thank you, sir. George Ferguson there of Bloomberg on the latest on Boeing. Let's get you an update on stories elsewhere this morning. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The Chinese government is planning a meeting with key officials over its troubled property market. Officials include ones in both the government and the financial sector. Bloomberg had reported on Wednesday that China is considering a proposal that would have local governments buy millions of unsold homes. Many of the properties would then be converted into affordable housing. China's cabinet is aiming to finalize that plan by the end of the month. Let's get you a quick check on Deere shares, down some 5.5% in the pre-market. The company cut its profit outlook for the year. Declining income from agriculture has put pressure on the world's biggest farm machinery maker. It's specifically falling grain prices that's crimped the income for farmers, giving them less money to spend on machinery. The company's CEO said that they are, quote, proactively managing our production to adapt to demand changes and position the business for the future. And Netflix will be airing 2 NFL games on Christmas Day. It's the latest push for sports for Netflix. The company signed a 3-year deal with the league, but that also gives them at least 1 Christmas Day game on Netflix in 2025 and 2026. It also adds just one more platform you're going to need if you want to watch all the NFL games. So as it stands, games are set to stream across Netflix, ESPN+, Peacock, Amazon Prime, and YouTube's Sunday Ticket in this season. And that's your Bloomberg brief, John.
Danny, thank you. Coming to a bundle near you, I'm sure. I've got problems with this. Got a few, but here's one. I don't get the football thing on Christmas Day. And I love watching sport, but Christmas Day is not for football games.
Do you think that families want to get around and talk the entire day? I'm just saying.
I do.
Okay, well, a lot of people are looking for something to kind of, grease the wheels a little bit.
Away.
You can all cheer for somebody. You don't have to deal with the uncomfortable topics.
How would you feel as AC Milan game?
I still wouldn't watch. And plus, the Italians would never play on Christmas Day.
This is true.
Come on, blasphemy.
Oh, dear.
Up next on the programme, Julian mandates.
We're going to be very sensitive. If we start to see the labor market crack, they'll be sensitive even if we're not quite at that 2% level.
That conversation up next. Equity futures just about positive. Live from New York. This is Bloomberg. A few things to look forward to this morning. In about 15 minutes' time, we'll get numbers from Walmart. Look out for earnings from them. Then after that, 8:30 Eastern Time, we'll get a little bit more economic data for you. Jobless claims just around the corner. Equity futures on the S&P 500 going into all of that, just about positive and adding to gains from yesterday at all-time highs at the close on Wednesday on both the S&P 500 and the Nasdaq. In the bond market, yields just about unchanged on a 10-year, 433.61. Under surveillance this morning, Julian mandates.
I know that the Fed is talking about we have to get back to 2%, but I think there's a little wiggle room there. I think, when it comes down to it, if they say, that those last few tenths of a percent are worth destroying the labor market, they will hold off on that. And they're going to be very sensitive. If we start to see the labor market crack, they'll be sensitive even if we're not quite at that 2% level.
Here's the latest this morning. US jobless claims due out in less than 2 hours' time. Constance Hunter of MacroPolicy Perspectives writing this. Our base case is continued growth fueled by continued productivity growth. But if the Fed has to cut because of weaker jobs data, the outcome is not as clear. We are probably looking at a soft patch to a mild recession. Constance joins us now for more. Good morning.
Good morning. How are you?
How encouraged were you by the data yesterday? You feeling good about that?
I am feeling good about that, and I think the Fed should be feeling good about that because we are on this trajectory towards a more normal inflation environment. The risk for the Fed, though, is that we're starting to see cracks in other parts of the economy, right? We saw the delinquency data come out, and we're seeing upticks in autos. We're seeing upticks in credit cards. You look at the ISM data. On the jobs diffusion index, that is pointing to some weakness. We saw a softer jobs print. And so the issue for the Fed is if they have to cut because it's jobs that weaken faster than inflation, they're behind the curve. And that being behind the curve puts us at a greater risk of a soft patch or a mild recession.
Can we just get into the evidence that might speak to them being behind the curve? How much weight would you put on something like, say, retail sales yesterday? How much weight would you put on that?
Well, I think you have to look at March and April together, right? Because you have Easter, you have Passover, you have weather, you have seasonals. So if you take them together, it wasn't super, super weak. However, we're seeing goods consumption finally moderate. I mean, we had 4 years of buying ridiculous amounts of goods, and now we're buying services. And that's a good thing, right? We're starting to see that come back. People are still behind on medical services, for example.
We were wondering how much to read into the initial jobless claims of last week, and a pretty big upside surprise, the wrong kind of upside surprise. We get initial jobless claims in 90 minutes time, a little bit more. How much are you seeing a shift? You talk about labor hoarding coming to an end. What does that do for the likely path of jobless claims?
Yeah, I mean, it would suggest that they're going to start moving higher. So we're watching all of the different data points pretty closely. We're also seeing that when people switch jobs, they're not getting as much of a premium in pay, as much of a bump up in pay when they're switching jobs. So we have a lot of signals that there's some softness in the labor market. Now, we could muddle along and bounce along here with this softer labor market and be just fine. Or it could start to turn negative, right? And so I hate to say data dependent, but at these parts of inflection points, you have to be data dependent.
It feels as though we've been part of an inflection point for a very long time. At what point do we just get a boost from the fact that the U.S. equity market is at all-time highs? You're seeing a rally into bond markets. You're seeing companies able to borrow. How much will that keep things afloat and sort of offset any weakening that might be happening?
Yeah, I mean, I don't think that we've been at sort of this inflection point for a long time. I mean, in 2023, we were very much in the camp that we were going to continue to grow, that there were a lot of forces that were going to propel that. And one of the forces that is propelling the stock market higher, of course, is the productivity story. And so, yes, that's helping a certain segment of the economy, but we're getting back into that K-shaped economy where the bottom part of the K is feeling the pinch. And like I said, you're seeing an uptick in delinquencies in auto loans, an uptick in delinquencies in credit card loans, and that is a sign of weakness. And that's a sign that people are really feeling the pinch of higher for longer rates.
When you're doing your analysis, the last data report was one of the lowest we've seen in terms of survey feedback since 2002. There's been a lot of questions in the market about how reliable is this data, but you're also scraping the internet for all what companies are saying.
Correct.
What do you rely more on? What do you think is more tangible, real data that shows what's happening in the economy?
I think that saying you're going to rely more on one thing than the other thing is not the right way to look at it. What you need to do is you need to triangulate from a number of different data sources. And any time that you have a regime change, you're going to see data that becomes noisy, right? When data starts becoming noisy like this, it's an indication that there's a shift afoot. And so we're very attuned to the fact that there is this underlying weakness, and it's sort of which comes first, right? The Fed rate cut and all the things that come along with that. And obviously one rate cut isn't going to do it, right? It's the promise that we're going to cut rates to the point where we can have a positive sloping yield curve. That positive sloping yield curve then changes the game with regard to lending. And it's a whole series of things that have to happen. And that's why I think the timing is very tenuous, because we're starting to get this weakness already. And the Fed is very unlikely to cut in June or July.
How does immigration play into how you're viewing the labor market? Because that supply side story has been really huge and able to keep wages down.
Yeah, and that was really significant when we had a very strong labor market, right? We had a tight labor market. More labor supply allowed the labor market to come into better balance. And now that increased labor supply, it could become part of a problem. Now, we think on balance it's good, and in the long run it's very good, right? We are, like most developing economies, we have lower birth rates. We're facing a world where we might have population declines. And so, I mean, not in the developed world, not in the emerging markets, but and that changes the game in terms of economics. So long term, it's good for the economy, but in the short term, we could see some softness in the labor market.
You mentioned the K. Is it worse for the bottom leg of the K?
Oh yeah, it's worse for the bottom leg of the K.
I don't think we've talked about that nearly enough. Could you give some time to that, please?
Yes. So first of all, when you look at the inflation data, and I think everybody knows now, I do this tweet every single month when the data comes out, and I look at the price increases from February 2020 to now, and then I annualize them, right? Because the absolute numbers look big, but the annualized numbers are still pretty big on a lot of components. And if you don't have a lot of disposable income, you're forced to pay. Those prices become much more onerous for you. And also, I mean, if you think of something like insurance going up, right? That's a harder thing to swap out than, say, beef prices go up. You can say, oh, I'll swap chicken.
So true.
Right? Swapping out your insurance carrier is a much more onerous thing. It can be done and you can push back, but it's not an easy substitution. And so people, I think, feel that they don't have a choice. And so that leads to not only the actual impact for households, but how they end up feeling. And it's sort of why you see in surveys like consumer confidence surveys, you see them so depressed, even though we've had this sort of 3-year expansion.
I think this goes some way, in fact, goes quite a large way to explaining what a lot of people might call an inconsistency between how people feel and what the data tells you. How people feel is in the data, isn't it? Isn't that basically what you're saying?
Yes. Yes.
This
all you have to do is look at the inflation data, and you see that's how you can see why people feel the way they feel. And of course, we need to be forward-looking. The Fed needs to be forward-looking. And if we look forward, you can see that that's not going to continue, right? But that's not people in the street who are just living their lives, that they're not thinking about that. They're not thinking about what it's going to be like going forward. They're worried that the past is going to continue.
We hope it doesn't continue, and it's fantastic to catch up with you. Thanks for breaking that down. Constance Hunter there of MacroPolicy Perspectives on the recent economic data. Much more economic data still to come at 8:30 Eastern Time. We get jobless claims, and of course, before that, we should get some numbers from Walmart. The question that we've been asking around this table, do you look at the companies or do you look at the data? Got a bit of an answer. Look at both.
Yeah, you have to look at both. I go back to what Mohamed El-Arian had told us about when everyone was in this transitory camp on inflation in 2021. What he said was they weren't listening to CEOs on the calls saying that inflation was still in the pipeline.
Walmart's been talking about deflation, haven't they?
Well,
Walmart execs recently.
Yeah, let's see how that goes this time around, given the fact that maybe we've seen some reversal. How much is Walmart, though, a real read on that lower K shape, and how much is there a lot of downshifting from people in the upper tiers? There are a lot of questions with Walmart. Very curious to see the earnings.
I'll say the B word again, both. think both.
Right.
Coming up in the next hour, here's the lineup for you. Mona Mahajan of Edward Jones. We'll catch up with Libby Cantrill of PIMCO, Chuck Grom of Gordon Haskett, and we'll speak to Michael Collins of PGIM Fixed Income. Equity futures on the S&P just about positive, following all-time highs on the S&P and the Nasdaq 100. From New York, this is Bloomberg.
The fact is, we're in a healthy nominal GDP environment. That's a good environment for earnings.
We would probably see a market that would keep running here.
I think the market has positioned itself for quite a positive perspective.
I would be a bit cautious, especially if we have another material leg higher in equities.
I've got 5,400 on the S&P 500 by the end of this year or the end of this week. I'm still working on the timing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg, and this is your equity market at all-time highs coming into Thursday on both the S&P 500 and the Nasdaq, closing at records yesterday for the first time since March. The year-to-date gains up by more than 11% on the S&P 500. Lisa, on the Nasdaq, up by more than 10.
Fueled by what? And this is really the key question. Initially, it was that the market could hang in there because rates were rising for the right reason. Now it's the market can hang in there because rates are probably going to keep on going lower because we're in this Goldilocks sweet spot. What I keep hearing from all of our guests is we're dancing on the head of a pin between the idea of some strength and Goldilocks versus some real weakness.
So let's get you some data. At 8:30 Eastern Time, we'll get jobless claims right now. We get some numbers from Walmart. I'll bring you the numbers briefly. First quarter adjusted EPS, 60 cents against an estimate of 53. That's a positive surprise. Second quarter adjusted EPS, the outlook, 62 cents to 65. The estimate was 64. Lisa, the stock up about 2% in the pre-market.
Really pointing to the e-commerce penetration and how much they've really gained market share there, which we've been focusing on quite a bit. The idea here that they did beat pretty much across the board raises this question: how much is this really about consumers feeling stronger, and how much is this Walmart consolidating some of their market share? Walmart only U.S. stores, ex-gas, up 3.8% versus the estimate of 3.4%. Sam's Club, an even bigger beat of 4.4% versus 3.3%.
We often ask this question when they deliver results. If it's good for Walmart, does it mean it's good for the economy? This is the commentary coming from the CFO speaking to Bloomberg. We're seeing customers trade into Walmart. We've historically been thought of for value, but now it's value, quality, and convenience. It's the higher income consumer going over there.
Yeah, and some of that has to do with the fact that they are looking for potentially better price points. You can find that at Walmart, but also that they are offering ways to get Walmart online, in store, or go to the store, pick it up, the same way you'd see from like a Target or Amazon. So now they are competitive in this space. Also interesting, I know they are trimming a little bit on the corporate side. We heard that earlier from the Wall Street Journal this week. Interesting to see what they're going to have to say about potentially trying to make internally trimming some of those costs and making it more robust for the future in terms of the corporate headcount.
So it's a beat on the top and bottom line. Just to go through this again, revenue's a beat. First quarter adjusted EPS is a beat, 60 cents against an estimate of 53. The outlook for the second quarter adjusted EPS, 62 to 65. The estimate, 64. And it looks like the high income consumer is flocking to Walmart. Walmart in the pre-market, slightly positive off the back of these numbers. Walmart in early trading is up at the moment by about 1.6%. That's the story for Walmart. Coming up on this program, we'll catch up with Mona Mahajan of Edward Jones with stocks at all-time highs. PIMCO's Libby Cantrill with the first presidential debate set for June, and Chuck Grom of Gordon Haskett reacting to these numbers just dropping from that big retailer. We begin with our top story. Stocks at all-time highs following the lowest inflation print in 6 months. Mona Mahajan of Edward Jones writing this: if we see a Goldilocks cooling of the economy, markets may welcome this outcome. While this scenario continues to be our base case, the tail risk is a more rapid downturn that also leads to rate cuts, but for the wrong reason. Mona joins us now for more. Mona, if Walmart is doing well, what does it say about the broader economy?
Yeah, thanks, John. It does feel like it's consistent with the narrative we've been getting over the last several days, which is retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are headed to Walmart to get that better discount. It does feel like the consumer feels a little bit stretched, but of course we're watching that lower income consumer more so than the broader economy. Now, keep in mind, both the labor market and the consumer started from a position of strength. So when we think about cooling, it's cooling from a very strong base. And so the scenario that we laid out, what we call a Goldilocks moderation of the economy, really means that the economy could soften a bit, but we're still talking about at trend levels, maybe slightly below trend levels. That kind of cooling also, keep in mind, can lead to better inflation trends. So if we are at the start of a bumpy ride lower in inflation, a Goldilocks cooling in the economy, that's an environment that the market will welcome. What they don't want to see is a more rapid decline, and that's what we're on the lookout for. We don't see it yet.
Well, what you're going through, and I think what you're setting up, is something we've discussed on this programme for a while, the difference between a welcome cooling and an unwelcome deterioration. Can we turn to the labour market? What's the labour market telling you versus, say, what corporate America's telling you?
Yeah, I think the labor market's an interesting story here. Of course, at 3.8, 3.9% unemployment rate, still near multi-decade lows, so still relatively strong. But what we're seeing is better supply and better demand, or a more balanced supply-demand picture. And I think the Fed has highlighted this as well. We are seeing on the supply side more workers returning to the labor market, perhaps after that pandemic hiatus. We also have the immigration story working in our favor from the supply perspective. But we are also seeing job openings move lower. So the demand for that labor is coming down. The supply of that labor is moving higher. We think that will lead to a nice cooling in the wage gains figure. And that's what we really want to see for services inflation. What we'd say more broadly also on the labor market, some of those leading indicators, not only job openings, but the quits rates. Keep in mind, folks are not quitting their jobs like they once were, perhaps because there's not as many openings to go into after you quit your job. But that tends to be a leading indicator for the labor economy. We could see an unemployment rate tick higher, perhaps above 4%. But in our view, that is still healthy and probably not getting much more beyond that.
So dancing on the head of a pin of this Goldilocks type of situation that seems to be great for stocks no matter what, regardless of how far we push on either direction. What would trigger some sort of end to this Goldilocks that so far has been an absolute panacea to stocks, and you see it continuing to be?
Yeah, look, I think that's what we are all thinking about. We had our first correction earlier this year. It was only about 5.5% peak to trough in the S&P 500. What we were really thinking about is what would lead us to become, for that correction to become more nefarious. Would it ever turn into a bear market, a 20% plus decline? Historically, when we are in that environment, when we are entering a bear market or in a bear market, we tend to see a few factors in place. One, the economy is usually hitting a recession. We may not be in it yet, but we're heading in that direction. Two, the Fed tends to be raising rates pretty aggressively. And then three, there's usually that unknown shock factor, which is hardest to handicap. But I'd say when we think about the first two, either a recession or Fed raising rates aggressively, that doesn't seem like a likely scenario as we look forward. So again, we don't expect that 5.5% correction to be it this year. We are headed towards an election season, et cetera. There could be more volatility ahead. But as long as we feel comfortable that that volatility doesn't turn into something deeper or more prolonged, we think it's an interesting opportunity for investors more than anything.
In the meantime, a lot of people have been waiting for that pivot point to really start to broaden out. We are seeing some broadening out in specific sectors, but broadening out to small caps and some of the value names you see as really coming into play when we actually see rate cuts. Won't it be too late then? Don't you kind of have to get ahead of it?
Yeah, it's a good point. And look, I think as we get opportunities along the way, any of that volatility that we noted earlier, that is a great opportunity to not only diversify, make sure you're balanced in your growth value cyclical portfolio, but thinking about rebalancing, thinking about adding those quality investments at better prices. We do think, one, as we get closer to Fed rate cuts, that will be a catalyst to unlock a more sustainable broadening of market participation. But two, as we head to the back half of the year, what we're seeing in earnings growth is that earnings growth contribution becomes more balanced between those growth tech sectors and those cyclical and value parts of the market. Q1 and even Q2 to some extent really driven by tech, Magnificent Seven, outperforming on the earnings front. But as we get more balance on earnings, as we get closer to Fed rate cuts, and by the way, if inflation continues to moderate, that's a good environment for a broadening of participation, not only between growth and value in U.S. equities, perhaps international continuing to play some meaningful catch up. And by the way, of course, your bond portfolio is starting to look a lot more interesting, too.
Mona, you talk about the probability of September rate cut was moved up higher. But what do you make of Neil Kashkari yesterday basically saying we might need to stay here a lot longer?
Yeah, we think higher for longer should be the base case. And whether it's September, December, or even early next year, the longer, for longer-term investors, the narrative really is the Fed was embarking on not just a 2024 rate cutting cycle, it was 2024, 2025, 2026. So a 2 to 3 year rate cutting cycle to get them at least somewhat closer to a neutral level. So we do think they are on that path for a multi-year rate cutting cycle. They will need to see as a prerequisite to that, as many of us have talked about, at least probably 2 to 3 better inflation prints. Now, we got a good one this week. Hopefully that resets the clock and we get a couple more in the months ahead. The one thing I'll say is I do think it's interesting the way the narrative is setting up for September, December, and then March. So this quarterly pace of rate cuts could be an interesting one for the Fed. At least it takes a little bit of the uncertainty out of it, makes it a little bit more systematic. If they can get the data to fall into place, I think that could be something they consider down the road as well.
Hey, Mona, appreciate the reaction to the earnings from Walmart and the commentary on the broader market. Mona Mahajan there of Edwards Jones. Here's the lineup for you for Fed Speak. Lisa, Barr, Barkin, Harker, Mester, Bostic. Just tons of them going into the weekend.
And we already heard from John Williams saying things are good where we are. We heard from Jay Powell. He's disappointed there isn't more progress. We know that we're probably going to have a more hawkish Mester. We know that probably what we're going to hear from Raphael Bostic is maybe even no rate cuts. Will it matter? That's my question. Ultimately, will the market really care?
And how much time do they have, I like to think, before the election? Everyone's talking about this probability of September going up. How perfect do these next data points have to be? Williams already hitting the tape this morning. I don't expect to get that greater confidence that we need to see on the inflation progress toward a 2% goal in the very near term.
Nobody's changing their base case in this market or seemingly on the FOMC following the data from yesterday, given how many times we've seen a head fake over the last 12 months when it comes to so-called disinflation. Just a final word on Walmart. Danny's going to go through the numbers. That stock is higher in the pre-market by more than 5% in early trading. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Yeah, it's backed off. It was 5.9, now about 5%, as you say, John. So just to recap, first quarter earnings beat expectations, and at the same time, it now expects the full year results to be slightly better. So e-commerce, that was one of the big drivers. That jumped 22% in the period. But as you all also noted, Walmart said that upper income shoppers are now flocking to the retailer too. The CFO told Bloomberg, quote, "We are seeing customers trade into Walmart. We've historically been thought of for value, but now it's value, quality, and convenience." To geopolitics, Chinese President Xi Jinping affirmed that the relationship with Russia remains strong. He told Vladimir Putin that ties between the two nations should last for generations. Putin's trip to Beijing is his first foreign visit since he started his 5th presidential term as Russia intensifies its war in Ukraine. Putin described the ties with China as, quote, "one of the main stabilizing factors in the international arena." Now, the very volatile copper rally is showing no signs of slowing down. It's because of a short squeeze in New York, and that's pushed COMEX prices to $1,200 above LME prices. That is an unprecedented level. Usually the spread is just a few dollars. Copper prices have been rising for months across the board, but this week's surge was specific to just the COMEX commodity exchange. High demand, low inventory, and global shipping issues have created the wild swings in prices. And that's your Bloomberg Brief, John.
Danny, thanks for the update. We'll catch up with Danny again in about 30 minutes' time. Danny going over the Walmart numbers, a beat on the top and bottom line. That stock is higher in early trading by 5.5%. Chuck Grom at Gordon Haskett about 20 minutes away to break down what he sees in these numbers. Up next on the program, the presidential race ramping up.
My advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
That conversation just around the corner, live from New York City this morning. Good morning. Equity futures just about positive on the S&P 500 by 0.1%. In the bond market, yields just about unchanged, 433.80. Jobless claims 1 hour and 15 minutes away. Under surveillance this morning, the presidential race ramping up.
The Republicans are going to win the Senate. It's a simple math question. The presidential election, it's still up in the air, but you look at every polling today, Trump is in the lead, and Biden's doing nothing to change that. My advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
I'm not sure if the Biden team is looking for maybe advice coming from the former Republican speaker, but there it is. Here's the latest this morning. President Biden and former President Donald Trump agreeing to at least 2 debates ahead of the November election. The first set for June 27, making it one of the earliest in modern history. Libby Cantrill of PIMCO joins us now for more. Libby, good morning to you.
Good morning.
How important is that June date?
I mean, it's important. So what we're telling clients is it's still early in terms of polling, so don't extrapolate from the national polls or even the state polls. However, I think the Biden campaign is looking at those polls, and they are concerned, particularly in terms of what it means for the Democratic coalition, which are sort of Hispanics, Black folks, and then also young people. There is really fragility in those demographics for Biden. So I think this is his opportunity to sort of reach out to those folks to really make this less of a referendum on his own administration, more of a choice between both President Biden and former President Trump. We'll see how effective it is. I mean, also the June date also gives him some runway. So if it doesn't work out very well, it's not necessarily existential for his presidential campaign.
How odd is it to have a debate before they even go to the RNC and the DNC?
I mean, as you know, very odd. It's actually never happened before. And usually, of course, the Presidential Commission on Debates is the one who sets the rules, sets the dates. It behooves them to have the dates closer to the election because more people are tuned in. So this is really sort of another erosion of norms, if you will, in Washington in terms of circumventing that process. But I think, it really does show you that the Biden campaign is trying to sort of flip the script here. They want to change the narrative. They want to get out to voters, and they think this is a way to do it.
How is it that they can't change the narrative when the individual they're up against is sitting in a court almost every single day of the week?
Yeah, well, look, what we talk to our clients about all day long is this idea of gas and groceries. The price of a gallon of milk, the price of a gallon of gas, these are sort of kitchen table issues. These things really matter to voters. And this is one of the reasons why, President Biden has been polling so poorly on the economy, even though on paper, the economy, to all of us look pretty good. But for the average voter, it doesn't. And so, yes, President Trump is sitting in that courtroom, but it really isn't swaying public opinion. I mean, this is the interesting thing. This is kind of already priced into the polls. And so, maybe short of a conviction, it doesn't seem like anything will really move folks. Now, if we do get a conviction, that might be sort of a different ball of wax.
Earlier this year, there seemed to be a reluctance on the part of Wall Street to really coalesce around Donald Trump. That seems to be shifting. The corridor between New York and Washington, D.C. seems to be getting busier. Why?
Yeah, well, I think that, like kind of the broader voters, folks want change. And I think, it's interesting, actually, just as an example of this, even the reaction to President Biden's announcement he's going to continue the 301 tariffs on China, and he's actually going to increase tariffs. That, under President Trump, did receive a lot of pushback on Wall Street. The announcement that was made earlier this week, it didn't even really move folks. And I think it just shows you that in many ways, people are sort of embracing some of the Trump era policies, that they do believe that, maybe he was onto something as it relates particularly to China. And then, of course, you sort of see that what's happening in terms of these two wars that folks are fighting, that we're fighting, overseas, again, inflation. So I think people want to change, and that includes Wall Street.
The interesting part to me is that analyst reports that are coming out right now, also, they used to be like the administrations are polar opposites when it comes to policies. Yeah. Now, every single one of them is maybe on the surface, but you look underneath and it's exactly the same. Do you buy that? Is that sort of the state of play right now?
Yeah, so of course there are differences, but I think that there are some really important similarities between these two gentlemen. First of all, they're not actually that different in age, and so in some ways they sort of grew up in the same generation. I really do think that they're both, more protectionistic at heart. And of course, we've seen that from President Trump, but we've also seen that from President Biden. President Biden was known as sort of Union Joe on Capitol Hill, and I think he's sort of lived that out here in terms of his administration. The other similarity, is just their approach on deficits. And I think this is actually a nuance because all of our clients are like, of course they're going to be bad for deficits. Trump will cut more taxes and Biden will spend more. That might be true. But I actually think the reason why structural deficits are going to be so high is because neither gentleman wants to do anything in terms of Social Security and Medicare. And if you look at actually the big source of government spending, that's the elephant in the room. And so unless Washington really tackles that, and of course these are really important programs, Social Security has lifted seniors out of poverty, so it's not to say that they should dismantle those, but without reform, those programs will continue to be a huge drag in terms of a big source of fiscal deficits, and neither has any sort of political appetite to address those.
You sit around the table with the fixed income team at PIMCO, and what's everyone saying? Are they saying we're going to get pushback from the Treasury market?
In terms of deficits?
Yeah.
So we have we had our secular forum, as John's very familiar with this.
I didn't get an invite this year.
I'm sure it's in the mail. That was a mistake
for last week.
So we did talk a lot about sort of this idea of just higher deficits for longer. The CBO is estimating sort of 5 to 6% deficits. You add back the expense of the Trump tax cuts, that goes to 7% every year. But does it matter? And I think this is the big question for bond investors. Does it matter? Is the U.S. sort of so exceptional that it can continue to spend, it continue to deficit spend? And I think that we're certainly worried about the sort of the longer term fiscal picture. At the same time, the dollar continues to be the reserve currency, and I think importantly, the Treasury bonds continue to be the reserve asset of the world. And as long as that continues, likely the music will go on for a little bit longer.
Lisa, I know this is a massive focus for you going into November, if not the focus.
Well, yes, actually. And, we talk about this and people shrug it off, the Liz Truss moment, this idea that there could be some policies, some tariffs, something that would trigger both an inflationary push and bigger deficits that could be the moment. What I find interesting is structurally, this market has not changed in terms of primary dealers. So it is getting bigger and bigger with a smaller sort of vice around, relatively speaking, around the corner. Do you see that as a possibility, that kind of
the Liz Truss moment? Yes. And one of our colleagues, Tony Krasinski, calls this the read my lips moment, where you have, politicians sort of saying something and then the market reacts. I mean, certainly, and again, we don't want to be too sanguine about this because we are absolutely concerned just about the sort of the fiscal picture over the long term. I do think that there are some pretty important differences, though, between kind of the UK and the US, just in terms of their the way their politics works. And importantly, we likely will have a split Congress under whomever is the next president. And even if there's unified control, if Trump wins and the Republicans win both chambers, it will be by very small majorities. And I think that will actually sort of hamstrung Congress in terms of how much they can do. So when Liz Truss was talking about all of these things, she had a cooperative parliament, right? So if Trump is talking about these things, he probably won't have a cooperative Congress, and the same thing for Biden. So I do think this sort of checks and balances actually does reassure the market, and it should, because it can in some ways be kind of the brakes, or at least slow down some of that spending.
If you're looking at a split Congress, what did you make of Speaker McCarthy saying the Senate's going to go GOP?
Yeah, so, as many of us know, so 100 members of the Senate, 34 up for re-election. Of those 34, 23 are being defended by Democrats. So Democrats just have a horrible map. If you look at those 23, and you know this very well, 8 or 9 are very vulnerable for Democrats. They're in places like West Virginia or Montana or Ohio. So it does seem that higher odds here that the Senate flips. But I do think there is some nuance here that it's probably going to flip by 1 or 2 or 3 seats. But so if it does flip, it's going to be a very small majority control. We're not going to get up to the 60-vote filibuster threshold, which is the important, in terms of actual additional spending, that's the important number. And neither party will have that regardless of the outcome.
Libby, when you speak to clients, how interested are they in the VP race for Donald
Very
Trump?
interested.
What do you say to them?
Again, number one question, that and the Fed, honestly, in terms of what Jerome Powell will do in an election year. I think that President Trump, kind of give credit to credit is due. He is running a much by his own admission, a kind of a much more strategic, professionalized campaign than he was in 2016. Again, by his own admission, where they sort of were surprised by their victory. This is much more kind of strategic and what have you. And as a result, I think you'll see that in the vice president choice. It's either going to be offensive in terms of trying to shore up some of the opportunities among Hispanic and black men, or it's going to be more defensive. And I do think this is actually a big liability for Trump that folks aren't really talking about, is just with independent women. He is, I think President Trump, one of the reasons why he was elected in 2016 was because of this demographic. In 2020, Biden was helped out by them. So I do think they're a big, important swing factor. And so I think you could also see him pick a woman. So it's either going to be kind of an offensive selection or a defensive selection, or it's going to be J.D. Vance, which sort of fits neither category.
Or Nikki Haley, which is what we talked about briefly yesterday. They've distanced themselves from that a little bit, but keep going back to that name.
That would be the entire party, and it would bring in a lot of donors.
Big time. Libby, it's good to see you.
Good to see you.
Thank you. Libby Cantrill there of PIMCO. Coming up on this programme, shares of Walmart rising after the company reported surging sales. Chuck Grom of Gordon Haskett joins us next with that stock higher by 4.6%. Live from New York, this is Bloomberg. Live from New York, welcome to the programme. Jobless claims about 60 minutes away. Equity futures on the S&P 500 just about positive by 0.1%, up 0.2 on the Nasdaq. The Nasdaq 100 on a 5-day winning streak, the longest since the back end of March. On the Russell, doing okay yesterday, just about unchanged this morning. Switch at the board and turn to the bond market. The levels we've been through and back down again. We were looking at 5% coming into May. We're back down to 4.75 on a 2-year. The 10-year not so long ago in the 4.70s. Lisa, all the way back down in the 4.30s.
And it's really come from real yields, basically the inflation-adjusted yield that you're getting on treasuries. Libby Cantrill was very diplomatic there, talking about how they have to care about the deficit. But basically, this is a big resounding cry. People have to give lip service to it, but in reality, they are not concerned about it at all. And right now, what is affecting the dynamic is a sense that we're not necessarily going to a 5% inflation rate ad nauseum and that the Fed will be lowering rates.
Let's turn rates to the FX market. I got all that, just about. Looking at rates yesterday, yields lower, dollar weaker against everything in G10. The dollar this morning stronger against everything in G10, including against the euro at 108.67. We're negative on that currency pair by 0.16%. Under surveillance this morning, the US warning Israel it risks creating a power vacuum across parts of Gaza, urging it to focus more on post-war planning for the region. Secretary of State Antony Blinken telling reporters, quote, "We can't have anarchy and a vacuum. That's likely, Lisa, to be filled by chaos."
This is a real problem that even some people within Israel and within the Israeli governing committee have raised. I mean, even the defense minister has said there is a problem with a lack of a plan coming from Netanyahu's camp. Again, we've talked about red lines. They've been crossed. We've talked about weapons delays. They're being shipped. What more levers does this administration have to pull at a time where, yes, he is polling poorly, and yes, in certain places, because of this issue?
I think this weekend will be critical. You have Jake Sullivan going over to Israel, also going to Saudi Arabia. Potentially, there's going to be more pressure exerted on Israel. And then when he goes to Saudi, it's can there be any deal that could get done? The problem the Saudis have is that they're not going to have any normalization with Israel if what happens in Gaza continues, which at the moment it looks like it's going to be continuing for quite a while. And if the Saudis want any sort of just U.S.-Saudi defense pact, will the Americans take that without that cherry of normalization with Israel, which was supposed to be a crowning foreign policy moment for this president?
Can we just sit on Rafah just for a moment? What's the state of play now? Seems to have gone quiet, at least over the last couple of days.
Looks like the state of play is that they are trying to move out the more than 1 million Palestinians that are stuck in Rafah. A lot of those individuals had come from the north, went to Rafah in order because they knew that Israel was coming in from the north. That's one thing. Two, this is very concerning for Egypt because it's right on their border, and potentially this is going to go against the peace agreement Egypt has with Israel. And the second is Israel's going in slowly, trying to still take out leaders of Hamas. Potentially, though, will we see a massive ground invasion? That's the big question mark.
That's the latest on the war in the Middle East. Here's the latest on Microsoft. It's asking as many as 800 employees in its China-based cloud computing and AI operations to consider transferring outside the country as tensions mount between the US and China, according to reporting by the Wall Street Journal. The company employs about 7,000 engineers in the region, with most, Lisa, based out of China, and the pressure, I imagine, on immigration lawyers to try and sort some of this out sometime soon.
The most interesting part of this story is that it got leaked out. Because honestly, how many companies must be doing this? How do you have cloud computing specialists who have the expertise, who are Chinese nationals in China, working on technology that the U.S. government says is national security issues and has to be reserved to the United States? This is ultimately a question of what are companies doing behind the scenes in addition to what Microsoft is saying? They're all probably thinking about their game plan as well.
My question for Microsoft is, are you decoupling or diversifying when you move these jobs out of China? Is it a diversification play? I'm obviously taking a crack at what the Biden administration has called we want to diversify, not decouple. But clearly, the direction of travel remains the same for these tensions between Washington and Beijing, and companies can't just sit on the sidelines and wait.
Well, we know what officials and companies say on the record. It's diversify, not decouple, because that's politically acceptable to say, of course. I want to turn to Walmart. The stock is up by 4.5% in the pre-market. They're reporting first quarter earnings that beat estimates and forecasting better than expected full-year results. Their stock is up by 4.5%. E-commerce was a big driver, jumping 22% in the period. Walmart saying upper-income shoppers are flocking to the retailer. Chuck Grom of Gordon Haskett joins us now to discuss. Chuck, you've had 30 minutes or so to go over this numbers. What jumps out for you, sir?
Yeah, I mean, on the top line here, 60 cents of earnings, 8-cent beat, high quality, better gross margins, better sales, better membership income. And I think that ties into your point just now on them starting to lure more higher income customers into Walmart. Inventory is in great shape. I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail in the first quarter. I mean, we'll get more results in the next couple of weeks, but we're pretty happy with the numbers this morning.
Chuck, where's that coming from? How are they able to squeeze more from the top line to the bottom line?
Gross margins were really successful. Their price leadership continues to do really well. Markdowns were lower year over year. That ties into their inventories being under last year's balance pretty significantly. And we're finally starting to see some of their other business mixes starting to impact the P&L, namely advertising and data. Very high margin, high accretive businesses starting to creep into the P&L, which is frankly a good creep finally.
There's a lot to dissect here. There's the shopping part of this, and then there's the Amazon competition on the other side. When you ask, where are they taking market share from? You mentioned advertising, data, their e-commerce center. Are they eating Amazon's lunch?
I don't think they're eating Amazon's lunch. I think they're taking share from a lot of different parts of retail. One of the things we do a lot of price studies across other competitors, the dollar stores, some of their larger peers, Target, Kroger, and their price leadership really has intensified. We're talking like 2x what their price leadership was for the past 5 years. In an environment where the consumers really seeking out value, they're winning.
At a time when there is some disinflation in certain pockets, how are they doing this while increasing some of their revenues? Is this just an economies of scale issue? Are they working with producers? Are they getting things from, say, China?
Yeah, they do. You make a good point because their general merchandise business, while still down, I believe about down low single digits in the first quarter, they called out unit acceleration. So we're starting to finally see some unit bottoming in discretionary, which is something that we haven't seen in a long time. They're still contending with deflation, particularly in categories like home and furniture, which are very deflationary right now. So units bottoming is actually a great sign, not just for them, but for other pockets of retail.
Back to Lisa's earlier point about market share. The CFO said we are seeing customers trade into Walmart. Who is it, though, that potentially some of these wealthier shoppers that they're stealing this market share from? If it's not Amazon, then who?
I mean, the logical competitor could be Kroger. It could be Target. You could argue Costco, but Costco's comps have been very, very strong. I mean, they just reported a 6% core comp for the month of April last week. So it's probably a combination of Target and Kroger to a degree. Maybe it's Amazon. A little bit of all the above.
What do you make of Walmart laying off some individuals on the corporate side?
I think that's them, continuing to try to refine the cost basis. They, as you saw, last week, I believe they exited close to 50 of their health centers. So I think it's just sort of their annual, looking at their cost base and trying to be prudent.
Chuck, you've alluded to this. The stock is up by close to 5% this morning. Talk to me about the kind of characteristics I inherit when I buy this name and put it in my portfolio. Typically, we talk about this name as being somewhat defensive. I've noticed in your research you've talked about the offensive characteristics that come with Walmart as well. Could you build that out a little bit, Chuck?
Yeah, I mean, I think for the past 20 years, Walmart's been a very defensive name. So when times get tough, investors will flock to Walmart. I think the model's changing. I think the business mix with advertising, data, marketplace. Obviously, we just talked about them trying to attack more higher income customers. So it's changing to a degree. It's balancing out, which I think is nice. It kind of reminds me of Costco. I mean, Costco, we talk about having both offensive and defensive characteristics, and I think Walmart's starting to get there. And you're seeing it in the multiple now, close to 25 times. And one thing we haven't talked about today is their traffic. The traffic was up close to 4% on a 2-year basis, actually accelerated relative to the fourth quarter. And traffic's the proxy for a retailer's health, and they had a great quarter.
Chuck, you mentioned Costco. Is this something you're seeing across the discount retailers then? Are they all moving in this direction?
There's a lot of similarities here between Costco and Walmart, both on the top line and on the bottom line. Inventory control, both, and I think the common denominator between both is really price and value, and they're leading in both, and that's paramount today. It's paramount always, but particularly right now when consumers are really frustrated with inflation, their ability to win right now is evident.
Chuck, before you go, top pick at the moment, what is it?
We still like Dollar General. I think their turnaround, we highlighted last October when we upgraded it. We think they'll have a good first quarter. We think there's a lot of debate in the stock. We like the risk reward here. But don't get me wrong, we still like Walmart. We still like Costco.
Appreciate the update, sir. Thank you. Chuck Grom there. Gordon Haskett following Walmart numbers with a stock higher now in early trading by more than 5%. Go through the picks there. Dollar General likes Costco, likes Walmart. I think that speaks to the macro backdrop of the moment for Gordon Haskett.
People are looking for discounts, and they're finding them at certain places, even people who have more disposable income. I'm just really curious to dig under the hood to understand how much some of these efficiencies are driven by, say, machine learning, how much is driven by trying to adapt more of an e-commerce type of model, and what the barrier to entry is for companies that are not that big. In other words, do we start to see an acceleration of the retailers that don't have access to that type of advancement?
They beat on the top and bottom line from Walmart a little bit earlier this morning in the last 40 minutes or so. Let's get you an update on stories elsewhere this morning. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. U.S. CPI data was accidentally published 30 minutes early yesterday. There's no obvious sign that the early publication moved markets, but the Bureau of Labor Statistics said it is launching a full investigation. It's not the first time that BLS data practices have come under scrutiny. About a month ago, Bloomberg reported that a BLS economist corresponded about CPI components, answering numerous questions with numerous Wall Street firms, including JPMorgan and BlackRock. And two brothers who studied at MIT have been charged with stealing $25 million in 12 seconds by exploiting a weakness in the Ethereum blockchain. Federal prosecutors in Manhattan have charged the brothers with fraud and money laundering over a heist that occurred about last year. The brothers allegedly spent months planning that scheme, studying trading behaviors and setting up shell companies. And world number one golfer Scottie Scheffler is the favorite as play gets underway at the PGA Championship in Valhalla. Scheffler has won 4 of the past 5 tournaments he's appeared in, including the Masters last month. He'll face competition from the likes of Rory McIlroy. He is hoping to win his 5th major and his first since 2014. And that's your brief, John.
Danny, thank you. One just had a baby, the other just got divorced. Plenty of drama in the world of golf going into the weekend.
This is where you have the segment where Jonathan Ferro talks to you, the viewer, because he knows that he probably cannot talk to Annmarie or myself with any knowledge whatsoever.
Everyone who's glossed over the sports pages knows about Rory's love life in the last couple of weeks, you know.
I know. It's like the...
I'm just excited about Happy Gilmore, too. Isn't that a golf movie?
I saw that.
Yeah.
I saw that's coming out, yes.
That's my knowledge of
Mr.
golf.
Sandler making a sequel. Very cool.
Crushed it.
At least you've got an interest. OK. Next on the programme, jumping from data point to data point.
We've had 3 low 0.4 CPI monthly prints followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. The market is going to be just waiting for the next data point before it does anything else.
The next CPI report, June 12th, for anyone interested in the calendar. That's the same day as the Fed decision, so that's going to be a very interesting day. Equity futures right now positive by 0.1%. Live from New York, this is Bloomberg. Equity futures on the S&P 500 positive here by 0.1%. Bond yields going nowhere, 433.61. There were 2 events on the calendar this morning. One was Walmart, beat on the top and bottom line. That stock is up by more than 5%. The next one is jobless claims, coming a little bit later this morning, 45 minutes away. A rare upside surprise last week. We'll see if it repeats a little bit later this morning. Under surveillance this morning, jumping from data point to data point.
We're close to learning that the next move the Fed will make will be a cut, not a hike, unless it's in years down the road. But, we've had 3 low 0.4 CPI monthly prints followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. The market is going to be just waiting for the next data point before it does anything else.
Here's the latest this morning. Bond yields falling to their lowest level since April following cooling inflation data yesterday. Investors bringing forward rate cut expectations, fully pricing in 2 cuts this year. Mike Collins of PGIM Fixed Income writing this. Powell is a chair that wants to cut. He will easily do 1, and if data allows it, he will try to do 2. We think this is going to be a very modest reduction. Mike, a good friend of ours in this programme, joins us now for more. Mike Collins, let's start with yesterday and talk about what that data means going forward from here.
Yeah, Jonathan, good morning. Thanks for having me again. Yeah, I think we're just moving in the direction we've been expecting, right, which is slight moderation in growth down toward 2%, maybe a little bit below 2% this year, and a continued moderation in inflation. I mean, if you strip out, we're back to stripping out shelter again, right, because that continues to be sticky, running, closer to 6% than 2 or 3. If you strip that out, both headline and core CPI year over year now are back in the low to mid 2s. So we're moving in the right direction. That's our expectation, that the shelter component will probably get cut in half as the year goes on, from close to 6 to closer to 3. So I think it's pretty good news on all front. The question is, as you heard from Williams this morning, why does the Fed need to do anything? I mean, we're in the 0 to 2 cut camp now, as you just indicated. And I don't know. I mean, I think 0 is probably the highest probability of a 0, 1, or 2 if you had to really push me on it. The Fed's MO historically has been sit on your hands, don't do anything until you're really forced to move, until the data really points hard in one direction or the other, and it is not doing that.
And Mike, I want to push you on it. I've got a quote in front of me from you at the start of April. You said this: the economy continues to be solid, inflation continues to be sticky and well above their target, the labour market is still rock solid, financial conditions are the easiest they've been since the Fed started hiking. Why would you cut interest rates with that backdrop? Mike, is that quote still your quote right now? Would you say exactly the same thing?
Absolutely. Now Powell is a dove, right? He is a labor market economist, kind of trained under Yellen. That's his MO. He's very sensitive to getting pushed from the left about the job market. If things change, and things can change rapidly, as we all know, Jonathan, if things change and the labor market really starts to weaken over the course of the year, then sure. A cut or 2 are definitely in the cards. But right now, the way the data is pointing, I would certainly still stick to that statement that their MO is to do nothing until they're forced to. And again, with the election looming, they start running out of dates, as we all know. So that's definitely part of the calculus.
Mike, we've been playing around with what this means for riskier assets, and a lot of people have had conflicting views about how much it actually matters, since we're seeing a stickiness and a lack of potential rate cuts this year because of positive economic trends. From your vantage point, does this push you further into risk assets and credit, or maybe make you a little concerned, hold back?
Yeah, we're continuing to be pretty defensive in credit. We're continuing to cut back. In fact, our recent trades have really been to continue to reduce exposure to corporate credit and increase exposure to things like, believe it or not, old-fashioned government-guaranteed agency mortgage-backed securities, where they have been a big laggard, not only this year, but over years now, relative to corporate credit. And they actually have some technical and valuation dynamics that actually look pretty appealing, right? If interest rates fall, if you get a weakening in the economy, which again isn't our base case, but mortgages would actually outperform corporate credit in my mind in that scenario. So again, that's an up in quality trade. That's a up in liquidity trade. That's a more defensive trade. And that's generally been our direction of travel.
It raises this interesting point about whether the biggest risk is not a reacceleration of inflation anymore, whether we've basically taken that off the table. And now people are just looking for the timing of when things slow more materially, which is the reason why people are getting bullish on duration. Is that essentially your baseline presumption?
Yes. I think the upside risk, we're there. We've had it. We've had the big boom in nominal GDP. We've had the overshoot in real growth. We've had the overshoot in inflation and nominal growth. We've had the overshoot in interest rates, Lisa. And I think, when the markets just a few weeks ago were pricing in a permanent funds rate of around 4% as the low terminal rate for the next 10 years, I look at that as an overshoot, and that rates were 50 to 100 basis points too high. And then look what just happened. They rallied 40 basis points really fast, right? So now maybe they're still 0.5%, higher than what I would say is fair value, which is probably more in the mid to high threes, let's say, on a 10-year Treasury, than in the low to mid fours. So yeah, we're still advising our clients that you get 4-handle yields across the curve on long-term rates, 4 to 4.5, and anything above 4.5 is the buy zone for adding duration to their portfolios.
Which really goes to this question that we were asking earlier when we were peaking out in rates about how much these other concerns about the deficit, about tariffs, about a structurally more inflationary environment would really be problematic for longer-term bonds. I have to say, it's sort of a gut check for me because I hear things like Ray Dalio talking about civil war and the possibility of the U.S. debt completely undermining the value of the dollar. David Solomon with Jonathan Ferro earlier this week talking about how concerned he is about the deficit. Is this all just lip service to basically cover any potential risk that they have, but that everyone just sees this as continuing to be the same old story that isn't going to come to the markets for?
I think of what a lot of people in the U.S., right? We're a very kind of nationalistic, U.S. centrist view here in the U.S., and it is a global bond market, and our clients are big pools of money all over the world. And if you look at, the fiscal situations elsewhere, I mean, they're at least as bad as ours. The supply is brutal everywhere. Europe's actually maybe a little bit of a shining star because they actually do have fiscal rules, even though they let them slip. But our rates, Lisa, our rates are 200 basis points higher than China, 200 basis points higher than German and European yields, 300, basis points, 350 basis points higher than Japanese yields. I mean, these investors control giant, sometimes $1 trillion pools of capital. And a lot of them, especially, pensions, insurance, and sovereign wealth funds and central banks, they buy fixed income. Right. And we are the world's bond market. And I think a lot of people in the U.S. forget that. And, the dollar is still, one of the strongest currencies. And I think it's, when push comes to shove, global investors will look to the U.S. bond market for safety. And I think that will continue to hold true.
Well, Mike, let's focus on that. Let's just get into it just a little bit more. The buyers are still showing up. Have you noticed any change in the background of the buyers over the last 12 months? Is it becoming more domestic?
A little bit on the margin, Jonathan, but we're also seeing more and more interest now, just recently, from non-U.S. investors into the U.S. bond market, right? And remember, it's not just our Treasury yields and our Treasury auctions, because a lot of these folks aren't buying just Treasuries, right? Yeah, in the auctions, it's a big deal. You need a marginal buyer to step in. But we have, the world's biggest, most liquid, diversified, regulated, attractive credit markets, which add a lot of yield and spread on top of that. And that's where you really see the demand. And that's one reason, to your point, Lisa, why credit spreads continue to be pretty tight. I mean, you have a lot of supply of Treasuries, not a lot of net supply of private sector debt, meaning corporate debt, structured debt, mortgage debt, et cetera. So that could keep those spreads relatively tight. But, on the auction size, yeah, they're gigantic auctions. And you think at some point there's going to be a failed auction. And we always worry about that, Jonathan. But, wow, we haven't seen it yet. And there's no empirical evidence that supply of Treasuries in and of itself drives the level of interest rates. That is driven by growth, by inflation, and by the ultimate path of the funds rate. That's been the case in my nearly 40-year career, and it'll probably be the case for a long time.
If it changes, you're on the list of names we'll call first, OK? Michael Collin to PGIM. Mike, appreciate it. Thank you, sir. Tons of supply, both on Treasury and in credit, and the demand stepped up. The buyers have been there.
I love that. He was kind of bearish on bonds, not on credit, on particularly lower risk credit, but he did point out that fundamentals are good and technicals are fantastic, which is the reason why you've seen the supportive aspect to the credit spreads. We're not seeing what people warned about. And we've seen that consistently. We're not seeing the rise in defaults, the sudden rejiggering, survive until 25. They've already survived, and they're going to be fine until 2026. We're not seeing a wholesale international buyer step away from the Treasury market. That's the reason why I think a lot of these concerns are still on the margins.
Abramo on the edge of constructive. You heard what Mike Collins said, the 0 to 2 for rate cuts this year, with his bias sort of leaning towards 0 and not to 2.
which is maybe the reason why he isn't getting into some of the riskier segments. But still, this idea that this is an economy that shows it can keep chugging along at these rates. And I keep going back to that. Has every asset class really reset to that idea? Have we really understood the idea of 5% being something that's just fine?
And embrace the old normal all over again. Third hour of Bloomberg Surveillance up next. Coming up, Matt Miskin of John Hancock, Michelle Meyer of Mastercard, Collin Martin of Charles Schwab, and the JPMorgan CEO, Dimon, sitting down with the brilliant Francine Lacqua. That's going to happen in the next 30 minutes or so. Look out for that from New York City. This is Bloomberg.
I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2%.
The higher for longer is going to stay there.
Above all, the Fed understands that reestablishing price stability is key. They're not giving up the 2% inflation target.
The economy is doing fine, and I think inflation is on its way to 2% by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City, there are many ways to get a read on the US economy. Here's three. You could ask the CEO of the biggest bank in America, Jamie Dimon of JPMorgan. Francine Lacqua is going to do just that in about 10 minutes' time. Don't miss that conversation. You could look for the data, 8:30 Eastern Time. Jobless claims, the estimate, 220. Or you could look to a large retailer, Walmart, in the pre-market, positive by more than 5%, Lisa, after a beat on the top and bottom line.
There is a cohesive thread coming together, and it isn't clean, and it isn't neat, and it isn't dramatic, which is what the market usually looks for. It is a slow softening, and that I think is clear with Walmart's extreme beat on the heels of higher income customers looking to get discounts in a still inflationary environment.
Bloomberg Intelligence, though, coming out after this report, and they're writing basically this appeal that Walmart has, even for the higher end, wealthy end of the consumer coming in, wanting that discount because inflation is biting. How long will that last, at least for that company specifically? But what it does tell us, at least in some of this hard data from Walmart, is that consumer sentiment, that's starting to resonate now. People are concerned about inflation.
I keep going back to the thing we've asked repeatedly on this program, a welcome cooling or an unwelcome deterioration. And what is the distinction at the moment between the two?
A welcome cooling is something that keeps inflation in check while not necessarily causing jobless claims to rise that much, which is the reason why 8:30 is going to be really important. An unwelcome cooling is something that happens and it is normal, which is usually it is not a clean sort of steady trajectory, a linear kind of linear kind of progression. It usually comes suddenly, and there's a jump up in unemployment. That's what some people are fearing, including Citigroup's Andrew Hollenhorst.
Jobless claims data, 8:30 Eastern Time. Check out the scores in financial markets, all-time highs at the close on Wednesday on the S&P 500 and the Nasdaq 100 for the first time since March. We had some weight to it, just a little bit. We're up by 0.05% on the S&P. In the bond market, yields unchanged, 4.33. Coming up this hour, Matt Miskin of John Hancock Investments as the S&P hits a new record high. JPMorgan CEO Jamie Dimon live from Paris with Francine Lacqua, and Michelle Meyer of the Mastercard Economics Institute reacting to jobless claims data. We begin with the big issue. Good news is good news. A cooler CPI print sending stocks above 5,300 for the first time ever. But John Hancock's Matt Miskin saying this. In terms of markets, we are still firmly in the bad news is good news regime. This can't last forever, as weaker economic growth likely means lower revenues, more defaults, and eventually plays into a weaker jobs market. Matt joins us now for more. Matt, just walk me through the regime you think we're in.
Yeah, we still think we're in this bad news, good news regime, and it's one that is challenging for asset allocators because treasury bonds are acting like small cap crypto stocks. I did not see this coming. This is something relatively new to this cycle. You know, I'm looking over at the CFA books and the Intelligent Investor and other finance books, and I'm like, where were you on that? But this is a challenging market and one that we think is going to be a bit counterintuitive. We think it's a phase. We actually like the treasury part, the higher quality bond part of the market in that rally that we're seeing than the junk rally. We would trim into strength of some of this lower quality market. Right now, the markets in general are sunning themselves on soft landing island. And we just think this is a great time to prune some risk.
So, Matt, you don't want to get out the umbrella, take a rest and take in the sun? No?
have a cocktail, maybe. No, we don't, John. It's something that, we think it's a bit of a welcome gift. And right now, the bar is lower for Q1, nearly for all these economic data points. So the CPI report, for example, inflation, this time last year was relatively high. So the year-over-year comps, what you're getting is you're rolling on some lower data, but the last year data was actually much higher. From here on out, inflation this time last year fell meaningfully. If you look at the month-over-month data. So now the bar is going to be harder to beat. Similarly with earnings growth right now, the bar in Q1 was lower. The bar goes up from here. The estimates for the street are about 9% in Q2, and from there it goes all the way to double-digit earnings growth by the end of the year, and 13% earnings growth for next year. We're bumping on about 21 times on a forward PE on the S&P. That's about as good as it gets being priced in. So right now we're looking for income as a return driver, alternatives. The dollar we think actually could be a great diversifier for portfolios here, and thinking about defense more broadly.
So bonds have rallied, stocks have rallied. You alluded to maybe liking the bond piece of that rally. Let's just sit on stocks. How would you fade that? What would you trim? Can you be more specific? Are we trimming what's happened in small caps the last 24 hours? Are we trimming what's happened with big tech over the last 5 days? Trimming the all-time high in the S&P, the Nasdaq 100? Where would you trim?
Yeah, we would start with the Russell 2000. And the Russell 2000 right now, we hear a lot of fundamental thesis around small caps being cheap. And actually, we totally agree with that. But nearly 40% of the Russell 2000 companies don't make money. They're not profitable. In addition, what's been driving small caps as of late are crypto miners and meme stocks. So if you have a fundamental thesis on the Russell 2000 that it's cheap or there's some sort of other macro thesis, what is actually driving it is a lot of speculation. And if you want to go long speculation, actually, that's a great way to do it. But that's actually the place we would trim first. Internationally, economies have been improving. We've been warming up to that, Europe in particular. But we think this China trade might also be starting to get stretched here, overbought. A lot of headlines. Every day you get a new headline out of China. But for us, the fundamentals still aren't strong enough to support it.
So, Matt, you're not in the camp of buying necessarily European bonds to try to diversify away from the U.S. and hinge yourself more closely to the easing cycle. That's not something that you're kind of leaning into?
It's something we're looking at, and duration is a tailwind there. I get it. It's been working. So congrats to those that grabbed that. But what we're seeing is just a massive yield disadvantage. We're thinking about bonds more as a longer term investment for clients. And we're getting, there was a point where we're up almost 6% yields on just a kind of mild credit bias in portfolios. Municipal bonds we like. But what we're seeing is the yield advantage is just so amazing in the United States. I know, Lisa, I'm really getting excited about the yield here.
You are. It's absolutely. It's inspiring. It's infectious, Matt, and I love it. Keep going. One thing that you say, as you sort of paint the picture that we're in right now, is that you say that we're coming off a mini cycle of its own that really started in November with the pivot from Fed Chair Powell. How much is that actually the way to look at this? And I think that it's a really good point that essentially the promise of rate cuts fueled risk assets enough to then fuel economic growth and inflation to keep things chugging along for longer than people expected. Is that how you view things?
Exactly. Yeah. And it's just all about context. And you rewind 6 months ago and the Fed was talking about rate cuts. So what did the bond market do? They said, sure. And if, in fact, we're going to double that. We're going to up the ante, if you will. And so they said 6 cuts were going to be priced in. And so pricing in 6 cuts, I mean, can you imagine if the Fed had said at that point, we're going to cut 6 times? I mean, of course, we're going to get a reacceleration of growth and inflation. So that was 6 months ago, and now the Fed is having to deal with that. They're going to have to, they're trying to peel that back. But that's what a mini cycle looked like. You saw a bottom in economic activity in November, right around then, bottom in inflation pressures, and then that's reaccelerated. And now as rates have come up, we look at housing, for example. Housing is such a critical part of this whole economic equation, and housing, the NAHB housing price or housing builder sentiment index that actually came out yesterday ticked down for the first time in 6 months. And if housing is starting to slow, that's a good indicator that this cycle, this mini cycle, might be slowing. And then again, we go back to those small caps, those lower profitable companies. They're not going to like if this mini cycle is slowing. Right now, they're loving the risk on mood, but we think the fundamentals are going to deteriorate underneath the hood.
Matt, appreciate the update. Matt Miskin there of John Hancock. Looking ahead to more economic data in about 21 minutes' time. Jobless claims in America. Up next on this programme, the conversation of the morning. Do not miss this one. The JPMorgan Chase CEO, Jamie Dimon, live from Paris with Francine Lacqua. That conversation just around the corner. Live from New York City, welcome to the programme. Equity futures on the S&P 500 just about positive. The economic data about 20 minutes away. Jobless claims just around the corner. Now it's time for the conversation of the morning. Francine Lacqua sitting down with the JPMorgan Chase chairman and CEO Jamie Dimon. Morning, Fran.
Good morning, John. Yeah, it's definitely my highlight of the day. Jamie Dimon, a lot to talk about. JPMorgan Chair and Chief Executive. Thank you so much for hosting us again at your Global Market Conference. What's market turbulence looking like right now? So we have the CPI print yesterday, markets rally. Are they getting ahead of themselves?
Yeah. So I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest
rates?
rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously, geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around?
Yeah,
the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay, that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
So is unpredictability the new normal?
I think it's been the norm since my whole life.
Has it?
Yes.
Not worse now?
No.
What happens between China and the US, and what does that mean for your appetite of being China?
Yeah, so the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we could work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I forgot the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place? So
if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary. Yeah. Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else. So.
We're in France at a global markets conference. What are you expecting from Basel III? What will Jay Powell put in place in the new rule book?
I should mention, by the way, because President Macron has done an outstanding job here. Pro-business, got us to move our trading floors here. He wants to grow his economy. There's much more innovation. We had a thing last night about innovation. So, look, Basel III, we've been quite clear. We thought it was excessive, not well thought through. I would love to know what the end game is. What are they trying to accomplish with private credit? What are they trying to accomplish with, like even the other day, 80% of mortgages left the system, and now the government is talking about having a bailout system for mortgage companies because they're no longer in a bank that has the ability to provide liquidity in tough markets. That would be the same thing in market making. So they're looking at it. I trust Jay Powell to look at and analyze what they need to do, how they need to do it. The other thing, which I'm not sure Europeans know, I have no idea. And it may end up in a lawsuit or something like that. But the amazing thing to me is that America ended up, the end game, 30% more capital than a European bank in America. And why are we arguing about international standards and then we simply don't do them? And also, I think the regulator should answer the question, what do you want? How do you want the system to work? Do you want it to private credit or public credit? Do you want mortgages out of the banks? Just dictate it. If that's the goal, just dictate it. If you don't want leverage lending in the bank, just dictate it. And I think we are guardians of the financial system. We bank 100 countries, and we're on the ground in 60 countries. We do great work for cities, schools, states, hospitals, solar, wind, climate, middle market companies. Is that what they don't want or they do want? They want to make it more expensive.
But they know,
companies.
or are they still trying to figure it out?
I think they've got to figure it out. I don't think it's quite clear from any analysis they did. You guys should read it and write about it. There was no detailed analysis about cost benefit, what they're trying to accomplish, what the outcome will be.
That's why we're asking you, Jamie. Talk to me about France. So you're positive on the president, Emmanuel Macron. I also know that you were at the Choose France event on Monday. If he relaxed labor laws, would you hire more in this country?
He did relax labor laws.
But if he relaxed them more?
Possibly. You know, we now have 1,000 people here. We have large trading floors here, which trade, I've got the number, $5 or $6 or $7, $800 million a day. When you have 1,000 people, you tend to hire more. More technology, more, and that's been true for us since I've been at JPMorgan. Once you have a very competent group of people and you have hiring and capability and friends, you tend to do more things there. So my view is we will be doing more things here. And it was the tax law they put in place, the regulations they put in place, the labor flexibility they put in place. Those things do make a difference. And very importantly, they don't just lift up JPMorgan here. We pay a lot of taxes here, which help lift up all citizens. I don't think President Macron did that for JPMorgan. He did it because he knows his country needs to grow, bring in innovation, and that's how you build a better country.
So the chief executive of the largest wealth fund in the world says that actually America's doing much better because Americans are less lazy or work harder than the Europeans. I mean, is that fair? Is that regulation?
I hate total blanket statements like that. I know a lot of Europeans who work hard, but I think when you see the things about work hours, I think it is somewhat true. Americans are hardworking. Anywhere you go around, Americans are hardworking, but I see that here too. You know, I don't think, and the innovation people you meet, they're working just as hard as the innovation people in the United States.
So you also, in terms of headcount in the UK, I think it's at the highest that it's ever been, and you're also you're giving money to try and retrain.
Yeah.
You've recently met with possibly the next Prime Minister because he's so far advanced in the polls. What do you think?
Yeah, look, I like the fact that both the Conservative and the Labour governments are talking about pro-business, simpler regulations, getting more innovation in the country, becoming competitive, and we all have too much debt. Growth is the best antidote for everything. And so having a growth strategy is good for a country, and it's good for the lower income people. And this training stuff is maybe the most important, is get training, jobs. That first job is a first rung in a ladder, creates dignity, more household formation. And I think countries have to do more of that, because if they don't, you can have a tough time.
But do you think the UK economy will change under Labour?
I don't know yet, but I was happy with what they were talking about. We had Rachel Reeves come to our conference too, that they're all talking from the playbook. We need growth, simpler regulations, more capital formation, more capital investment, meaning proper taxation, because that's the way to help our whole country and all our citizens. So that is what we should all be doing.
Jamie Dimon, we talk around, India all the time. Is this a decade for India, and does it somehow counterbalance China for, world growth?
Yeah, look, I think India has done a very good job. And, when you look at India, yes, it should have a very bright future. I'm not saying it's a counter to China, but a very bright future. And I think we should all be reaching out to India. That, they have to stay non-aligned because they're kind of where they are in the world between Russia and China. But, they're a democracy. They're a natural friend of America and the Western world, and we should all be helping them. And they've made a lot of changes there. Infrastructure, transfer payments, 700 million people bank accounts that are going to be very good for that country.
So what does that mean for JPMorgan?
Well, we're not in the retail business there, but
will you be in the future?
We have 60,000 employees there. We got big campuses, high technology, and we're expanding our trading, our research, our investment banking. Yeah, we're there in a big time. Yeah.
Can you talk to me a little bit about JPMorgan and how, you've had a number of high-profile departures. How does that change, actually, the way you focus your business and how you run things going forward?
Not at all.
Nothing? Zero? If you were to buy anything, what would you buy?
Oh, that's different. Look, we can't buy banks. You do know that. So,
Well, you could buy your European bank. Could you?
I wouldn't even try. I think the American regulators hate it. I think the regulators here would hate it. Even if they said, go ahead and do it, I'd probably be in courts and things for a year and a half. Huge distraction to my own company. I'd rather just say we want to add clients in this country and clients in that country. We'll add bankers and technology and branches. It's just a better way for us to grow.
Okay, but if you could buy anything, not a bank.
I can't tell you.
But you're thinking of something?
Yeah, we always look at stuff, yeah.
What region?
We're not looking at any major acquisitions, anything like that.
Technology?
Right now, if you look at what we're doing, we're adding literally, we have Investor Day next week. We're adding retail and wholesale branches. We're adding them in the United States. We're in almost all the major 100 cities there now. We're adding commercial banking all over Europe and Asia. We're adding technology around payments and even a blockchain called Onyx to move data and maybe move money one day. We're constantly investing. We have 200 people, 2,000 people in AI and machine learning, 400 use cases on the way to probably 800.
I know. So if I speak to you in 5 years, how much bigger and how much different will you be?
You'll probably be speaking to a fake Dimon who's just answering questions.
An avatar?
An avatar, yeah.
Do you think about technology a lot?
Yes, all the time. Every meeting we have, this has been true my whole life, when we have any management meeting, your technology agenda is on the table. That includes AI, cloud, just more analytics. What are you doing to do things better, faster, quicker for clients? Digital. A huge amount of digital services, integrating them better, automating them better.
But that would change. I mean, that will change, I guess, the heart of banking. Does that mean that you'll see more winners and losers because of the technological advancements?
So technology has always changed. The heart of banking, moving money, holding money, advising money, raising, that won't change. And you have to do that according to rules, laws, regulations by country. What'll change is how you deliver it. So like right now, you go on your phone and you can move money and buy stocks. That wasn't true 20 years ago. So yes, everything you do will change because of technology, but you'll still have to move money, budget, raise money, make investments, et cetera. So the core won't change.
But will it change?
And regulations may change that too, obviously. So
in the U.S., so again, would a Trump presidency be more favorable to banks when it comes to regulation?
I don't know. I mean, I am unhappy with the amount of rules and regulations coming out today. I don't know what a second administration of either one would do. I'm hopeful that they focus on growth, which is good for the citizens, which is good for the country. And I would help anyone I can to do that for my country. I'm quite patriotic about that. And I do think you need
in terms of serving?
I think you need helping.
Oh, helping as the bank.
Yeah,
okay.
Exactly.
It's good to get that clear.
Exactly.
Okay, Jamie Dimon, thank you so much for joining us. That was, of course, the JPMorgan Chief Executive Officer. With that, I'm going to send it back to you, New York.
Hey, Francine, thank you. Just a fantastic 15 minutes sitting down with the CEO of Jamie Dimon, the brilliant Francine Lacqua, breaking down the markets there and everything else. I think what you heard there, it's really important to point out, that was not an economist giving you a base case, a strategist giving you a point target for year end. It was a chief executive talking about a very wide range of outcomes that he needs to manage wherever they fall.
What I find interesting is his range of outcomes still has skewed also to the idea of yields going higher, of inflation remaining stickier. Again, not a base case. He's not calling for yields to go to 6% or 7% or 8%. But how do businesses hedge against that possibility at a time where they have to be prepared for risks that really are maybe a little bit more unpredictable right now?
If you're a bank executive, these are things that you'd be worrying about. MH, also a lot in there about foreign policy and international risk too.
Yeah, interesting what he had to say about the U.S. and China can work together. That's the complete opposite of what we've been seeing, what potentially we will see, whether or not it's Trump or Biden next year. I mean, just this morning, the Wall Street Journal coming out from the Homeland Security Department, how they're blacklisting a number of Chinese companies due to what they're calling forced labor and Uyghurs. We continuously see time and time again, whether it's export controls, tariffs, sanctions. There's a lot of daylight between this relationship, but he says they're not necessarily natural enemies.
If you're just joining us and you missed that conversation, you want to go back over it, it will be on the Bloomberg terminal and on Bloomberg.com. Francine Lacqua sitting down with the JPMorgan CEO, Jamie Dimon. In about 50 seconds' time, we'll get jobless claims. So let's work through the financial markets and bring you the economic data. Equity futures going into it, just about positive by 0.1% on the S&P after closing at all-time highs in yesterday's session. On the Nasdaq 100, on a 5-day winning streak through Wednesday, this morning up by 0.15%. If we turn to the bond market, we've talked about the levels we've been to over the last month, through 5% at the front end of the curve on a 2-year, all the way back down to the 470s, 474 this morning, and up about 2 basis points on a 10-year. Lisa, life in the 470s was only a few weeks ago. We're back down to the 430s.
With people really looking at this idea that, yes, we got the lowest inflation rate of the year. We can finally see disinflation back on track. We hear from a host of Fed speakers. Is that actually the case?
Let's get to the economic data. You've had the Fed commentary. Jobless claims in America last week came in at 231. We got the wrong kind of upside surprise. Right here, right now, back down to about 222. We were looking for 220. That was the estimate. We came in at 222, down from the previous week of 231. If we get a revision, I'll bring it to you. The financial market reaction to that, equity futures positive still by 0.2% on the S&P, on the Nasdaq by 0.2%. Also in the bond market, if you can switch at the board just briefly and look at the front end of the curve, the 2-year just about unchanged, 473. Lisa, if you were concerned about maybe a continued breakout in jobless claims, you don't see it this morning. this week?
It doesn't seem like this is a labor market that's seeing massive fissures. That said, Constance Hunter made a really good point where she was saying we're seeing the end of labor hoarding. There seems to be a change in that dynamic to something maybe more normal. It isn't necessarily things wholesale shifting, but there is this creep higher in the sense that, remember when jobless claims always came in below expectations? That's shifting, right? I mean, it was expected to be lower and it came in, albeit 2,000, but a little bit higher.
We've had some Fed fakes, though, where you sort of break out above 200 and then come all the way back down to 200K again. This is what we're trying to work out about yesterday's inflation data as well. Is that the head fake or the real deal, or was Q1 the head fake or the real deal? What are we going back to this summer? Where will we be, not in 2 months, 3 months, 4 months, where will we be next week, the week after that? Because this narrative keeps changing from day to day.
And part of the problem is, and I keep going back to this, it's so confusing because there's so many different populations. There are different labor markets that are kind of overlapping. There are different consumers. We were talking about that K-shaped recovery, and it's getting that much more difficult for the lower income tier. We're seeing even the upper income tier with Walmart go down the income spectrum. At what point is there consistency in the reads across some of the data that we can get a narrative that actually sticks?
A ton of economic data in front of me right now, but the highlight, jobless claims 222, the estimate 220, the previous week a revised 232. With us around the table, Michelle Meyer of the Mastercard Economics Institute and Collin Martin of Charles Schwab. Michelle, first to you. What do you make of that economic data? And let's sort of fold it into yesterday as well. What do we take away this week?
Well, I think it shows that the economy is evolving as it should be as this business cycle matures. So initial jobless claims still very, very low. Little to no evidence of challenges in the labor market. If you look at the 6-month moving average for job creation, we're running at about 250,000 jobs per month. You have more labor force engagement. You certainly have the support from the labor market. On the inflation side, I do think you're seeing potentially some moderation, certainly in the goods side, less on the services side. But it's part of what you would be expecting to see as this cycle evolves, where the goods economy kind of overinflated and now it's correcting. The services economy is still seeing a lot of momentum and strength.
One piece of the data puzzle we didn't touch on just then, retail sales. How much weight would you put on that weak print yesterday?
I don't think it's that important on a month-to-month basis. It follows off of very strong retail sales numbers earlier in the quarter in Q1. So if you look at the trend for consumer spending to start this year, it's been strong. It was a critical part to the upside beat to Q1 GDP. If you look at real consumer spending tracking for Q2 from the Atlanta Fed measure, we're running at about 2.5% on an annualized basis in real terms. That's still a consumer who's out there actively participating in the economy.
Collin, do you agree that this is sort of a shifting economy to where it should be, not necessarily falling off a cliff?
Yeah, I think so. When we look at the data, we see things slowing, but it's cooling but not cool. And we're not expecting things to fall off a cliff right now. If we look at the inflation front, I think it's a step in the right direction. But if we still want to look at the actual numbers, and CPI, obviously we're going to focus more on PCE, but with CPI, 3.6%, 3.5% area year over year, that's still a little too high. And 0.3%, it was an improvement from the first quarter, but that's still elevated if you look at it from an annualized basis.
We were talking earlier about how no one shifted their views after yesterday's data, and it seems like no one's shifting their views in general, and everyone's just sort of entrenched with whether we've nailed this soft landing or whether we're heading toward Armageddon or whatever you want to say. I'm just wondering, it seems like the market's weighing in, and it's just basically celebrating the victory of the soft landing. Collin, would you weigh in and basically say, yeah, let's celebrate?
We're not celebrating just yet. We try not to get too tied up with every single release, because we do have more of a long-term view when we're providing our guidance. It's a step in the right direction. We have not changed our views. Coming into the year, we expected 3 cuts. We shifted it to 1 to 2. Yesterday's report, again, good news, but that's not getting us back to the 3-cut area right now. So we're still comfortable with 1 to 2 right now.
What's the date for that first one? July, September? What are you looking at?
I'd say September. I saw a comment about July, and that just seems too early right now, given what we saw in the first quarter.
We get another CPI print in the middle of June, same day as the June meeting, another one in July. Back end of July, you get a Fed meeting. Is July still too soon?
I think it's in play. I think at this point, the Fed has made it very clear they are monitoring the data. They're looking at financial conditions. They want to understand the evolution of the economy. And they're not talking about cutting interest rates because there's a significant problem in the economy. They're talking about normalizing monetary policy. And I do think that's an important distinction when you think about what are the triggers to get them to start shifting the interest rate environment.
Let's run with that word. They're talking about normalizing without talking about what normal might be.
Fair, yes.
Okay, so what is normal going to be in this regime? And why aren't they talking about it?
I think they don't know. They don't know what those star variables are. But it does seem like the commentary is that they're probably higher than they had previously thought, right? That the star variables are likely a bit higher, that we're probably going to be in a higher for longer rate environment, maybe a little bit stickier, higher inflation, a little bit, maybe higher potential growth rates, at least for now. And that's going to influence as well how they think about the timing of this cycle.
You put out data that I thought was fascinating. A record high, 15.9 million Americans traveled internationally in the first quarter. Cruise liners are going bananas.
Yes.
You have people basically spending, incredible amounts every day on experiences and going, jet skiing and going bungee jumping. And there's this question of, okay, well, how much does a Fed cutting rates now basically give a gift to people who are invested in this market, can really benefit from the upswing and not fight the inflation that's causing people at Walmart to really be selective?
Look, I think when you think about what's happening in the travel economy, it is super meaningful. Those stats that you just referenced in the report we just put out in the Economics Institute of Mastercard is huge. I mean, this is a sector that is seeing extraordinary growth in terms of the number of people who are traveling, the different destinations that they're trying to embrace, the intention that they have in terms of choosing where they're going based off of what they're seeing for currencies, what they're seeing for affordability, for new and interesting places to visit that they haven't been. There's a lot of demand out there to have these types of experiences, and travel is the #1 experience. And the fact that you're seeing this type of growth tells us that the consumer has purchasing power. The consumer is still active, and the labor market is still very much supportive in that regard. So I think for the Fed, they have to look at the big picture. They have to look at total spending, but then try to understand what's happening in terms of the moving parts within that.
So, Collin, if I take a look at, for example, a hotel that cost me $200 2 years ago, and now I'm looking at $400 with what John would say would be fewer services, I'm wondering, how is this not inflationary, given the fact that people are willing to spend, who are in a cohort who have money to spend, even at a time where there's an increasing cohort of people struggling under the weight of inflation?
Well, I think it goes back to the sticky point right there. But if we look at what does the outlook look like going forward, is there going to be a reacceleration right there? Because I think the idea of excess savings, I think we can put that behind us right now. It's not something I really think about too much. I look at the labor market, as we've talked about, still strong but cooling. We're seeing wages still grow. Until we see more of a sharp fall off, we'll probably continue to see spending remain high, but we are seeing some worrying signs out there. I think Michelle probably has more data than I do, but on the consumer credit side of the equation, we are starting to see those delinquencies turn up a little bit. We're seeing more and more credit, although the pace has slowed down a little bit. That's something that we're paying attention to, because if we're using more and more credit in a high rate environment, we think that over time that should slow things down.
Just for the record on the hotels room, what I don't like, and other people agree with me, is when they sort of say they're going green, so they're not going to do the laundry, unless you really want a clean towel, in which case leave it on the bathroom floor. That's what annoys me. Okay. You've spent a significant amount of money to stay in a decent hotel, and then they want to sort of like pressure you into this sort of moral conundrum. Do you have a clean towel?
I'm sorry.
He also doesn't
or
like
do you
hotel
save the
points.
planet?
Do you have to have
clean
like
towel?
There are 15 towels
planet.
underneath the sink usually. Do you use every single one of them?
Sometimes I use a lot of towels.
Well, that's an image that I really.
Sometimes I use a lot of towels. Then you want a clean
segment.
towel.
Yeah, you want a consistently.
You stay in a hotel 2 showers a day. Why not?
Okay.
You paid for it.
Why not 5?
What a conundrum. Clean towels, save the planet. It's tough, right? Michelle, we won't talk about that. Let's talk about the economic data. You don't want to talk about that. Delinquencies. Is that normalizing, or is that something to worry about? What's happening around those kind of themes? People struggling with debt.
So if you look at the New York Fed survey that came out this week, which I think is probably the most comprehensive measure of what's happening in the state of household balance sheets, you have seen continued move up in delinquency rates just above where they were prior to the pandemic. So it's still part of this kind of normalization process. And I think it's partly a function of the fact that interest rates are higher, which is part of what the Fed was intending to do by increasing interest rates in an environment where the economy was very, very hot. The goal was to cool down the economy, prevent inflation from becoming unhinged, make sure that we can continue to see the economy grow closer to trend for a longer period of time. So I think it's part of what's playing out in a high rate environment, as Collin noted it as well.
We were all seduced by this idea because this is the outcome we want. We wanted to be able to get inflation back down to 2% without the pain that Chairman Powell talked about in Jackson Hole in August 2022. It feels like we've got so far without the pain, got to about 3.
Yeah.
Do you think we can get back down to 2 without the pain?
I think we're on path to do that. I also think there's a question of, do we have to be right at 2%? for them to feel like they've achieved what needs to be achieved and to feel as though we've reached equilibrium. The Fed and central banks broadly have always talked about this idea of a range around the target. And for a period of time, post-financial crisis, inflation was running significantly below target, which led to this discussion around asymmetry. And now inflation is running a bit above. So as long as there's a belief that long-term inflation expectations are well anchored, which they'd be relying on surveys for, I think that, as long as we're in that range of 2% inflation, I think that is probably quite acceptable.
This is what David Kelly was talking about yesterday and how maybe the Fed needs to look at what Canada's doing, look for a range of 1% to 3%. What do you make of that? Do you think they should be targeting a range, not be obsessed with that 2% target?
I don't want to get into what their policy will be, but I think I'll piggyback on Michelle's points about what they're probably looking for. They don't need to see 2%. They've told us they want to see it moving down towards 2%. They don't need to wait for a magic number before they start to cut. We think that will probably come soon, but what's important, I want to go back to another point of Michelle's about what is normal. I think in this environment, given that the economy has remained resilient, given that things are going pretty well, when they do start to cut, it's likely not going to be because they need to save the economy or something like that. It's more just bringing it down so real rates don't get too restrictive. But what we're trying to figure out is, well, what is that ultimate landing place? Because that has implications for all parts of the yield curve.
Well, Neil Kashkari talked about that yesterday and said maybe they're not restrictive enough and we should be putting 2 feet on the pedal in terms of the brakes. Do you think that actually they're not restrictive enough and they might just want to hold for even throughout the entire year, not wait till 2025?
It's possible, but I don't necessarily agree with Kashkari's points. He's been saying that for a while. I think he's in the minority. It seems like there's enough officials out there, Powell included, that think it is restrictive. But I think there's a difference between Fed policy and then actual financial conditions. And when we continue to see stocks rise, credit spreads stay low, when you look at it from that point, from a wealth effect, maybe things aren't as tight as some might think.
And here's the psychology portion of the Thursday morning.
Oh, Therapy
Michelle,
Thursday.
Therapy Thursday, as people try to grapple with, am I getting too sanguine on this soft landing? We hear it. There's sort of an angst about being with this consensus and this sort of hopeful feeling. Michelle, do you feel that with your colleagues, that sort of people feel like things are okay, but they feel reluctant to say it because it kind of feels wrong to lean into kind of the consensus and where we're at?
Well, I don't know. I mean, I think for me in the institute, we've been pretty optimistic for a while. I'm feeling pretty comfortable with that.
Well, there you go.
Maybe I'm
take a victory lap.
But I think that people are careful because this is a very different business cycle. Right? It was a business cycle that was spurred by one of the largest external shocks that we've seen in a very long time, which was the pandemic. And so much has transformed in the economy since then that I think people are trying to figure out how much are cyclical changes, how much are structural changes in the economy, where do we ultimately settle, back to this conversation around these trend variables. But I do think that examining the real-time data has very much led us in the belief that it's an economy that still has room to grow, and we feel comfortable with that.
Well, and Collin, from your perspective, you still like duration. You're saying you have an opportunity, keep going, which feels comfortable if you look at history and you think, okay, we're going back down. Do you still have that conviction, and is it ever difficult to just stick with it?
We still have that conviction. We've had it for a while now. We're probably at 12 to 18 months where we've been suggesting that. The good news is, if you're an investor or a Schwab client and you haven't yet, you still have the opportunity. I mean, we're not at the highs of this year, but we still have that conviction because we don't expect yields to rise much further from here. In order to get, say, the 10-year, for example, to get back to that 5% level, we think we need to see really that reacceleration in growth and inflation, and then the expectations for Fed policy to shift from either not just higher for longer or cuts, but actually to a hike. And we just don't see that happening.
What happened to this idea of the industrial policy being inflationary, this idea that tariffs would be inflationary, that people spending their baby boomer money would be inflationary? What happened to all of that seems to have suddenly been forgotten, or not forgotten, but dismissed by, this is a new era, we're good, it's not going to be like that?
Well, things are going well, so maybe it's just kind of the psychology aspect, and if you see your balances going up and if you can handle that, if you locked in a low mortgage rate, maybe things are looking pretty good. But we're still holding the line that we think over time we're going to see those long and variable lags, and that the longer the Fed holds at these rates, it should slow things down. One thing we are looking at is how this impacts the credit markets, especially where we can see some cracks is maybe in the junk part of the market. Higher for longer should hurt them more because they're more sensitive to high rates.
Michelle?
Well, I think what you raised around how do you think that these bigger issues impacting inflation, I think they are all impacting inflation, right? It's difficult to understand exactly why we're at this stickier inflation environment, right? You do know that, yes, in the pandemic, when it first occurred, supply chains were distorted. You had this big cost push and goods prices set higher. And they're starting to correct, but if you look at the level of a lot of goods prices, it's still significantly above where it was prior to the pandemic. So is that still the pandemic hangover, or is it some of the factors that you suggested, which are a little bit longer term in nature? So it goes back to this idea of, will we have a bit stickier inflation? Will we have a little bit higher for longer interest rates, as Collin was just talking about?
And this is what Jamie Dimon was talking about with Francine about 20 minutes ago as well. Michelle, thank you. Going to leave it there. Michelle Mather of the Mastercard Economics Institute alongside Collin Martin of Charles Schwab. Collin, thank you to you as well. If you are just joining us, welcome to the programme. Moments ago, we had jobless claims in America coming at 222. The estimate was 220. The previous week was a revised 232, so a little bit lower on the week at least. Equity futures still just about positive by 0.1% on the S&P 500. Going into the opening bell about 44 minutes away. If we check out the bond market, yields climbing higher just a little bit, creeping higher by 3 basis points at the front end of the curve. The 2-year just below 4.76 on a 10-year yield this morning, just about unchanged at 4.34. And to check in on the euro, the dollar absolutely slammed yesterday against G10, taking some of that back this morning against G10 again. Against the euro, 108.65. We're negative on that currency pair by 0.2%. Collin, Lisa, talking about cooling but not cool. And Andrew Hollenhorst of Citi talking about slowing, but I guess not slow. The US economy is finally slowing down with job growth decelerating, consumer spending on goods declining, and looking for that first rate cut, over at Citi at least, to come in July.
What did Matt Miskin say? We're all sunning in the glory of a soft landing sun, and that seems to be where everyone's at, essentially just basically threading this needle perfectly as everyone dances on the head of a pin.
A soft landing island, I think he called it.
Soft landing,
soft landing
Thank
island.
You. I knew I was not getting it totally right. It was much better
for this
than
summer.
that. Yeah.
And Bramo baited me with that hotel point because you know I was going to bite.
I knew.
You know I was going to bite. Okay.
You're welcome.
Let's get you an update on stories elsewhere this morning. I'm not sure the audience feels the same way. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bridgewater founder Ray Dalio told the FT that he's concerned about U.S. markets and the growing geopolitical tension. He said that rising U.S. debt levels could impact the Treasury market and that the risk of another international conflict could reduce foreign demand for Treasuries. The billionaire said that while the best parts of the U.S. are still the best parts for the world and for capitalism and innovation, that investors should look to move some of their money elsewhere. Senator Bob Menendez is blaming his wife Nadine for gold bars seized in their home by the FBI. The New Jersey politician is currently on trial for corruption. Prosecutors allege that Menendez is at the center of a multifaceted scheme that involves bribery and acting as a foreign agent. The senator's defense attorney pushed back on claims that he took those gold bars and cash and a luxury car from two businessmen in exchange for favors, instead telling jurors that the gold in particular was given to his wife without the senator's knowledge. And Netflix will be airing 2 NFL games on Christmas Day. It's, again, the streaming giant's push into sports. The company signed a 3-year deal with the league, which will see at least one Christmas game on Netflix in 2025 and 2026. But it also just adds one more platform you need to watch the NFL games. They are set to stream this season across Netflix, ESPN+, Peacock, Amazon Prime, and YouTube's Sunday Ticket. And that's your Bloomberg Brief. John.
Messy. Danny, thank you. We've got so many things to say about this, so much to say, but here's another point. If you don't know where to find the sport, I don't think it's good for the sport. I see this in other sports as well. I've settled down a little bit with Premier League football in this country at the moment, but when it went to Peacock, which games were on Peacock, which games aren't on Peacock, when you have to sit there on a Saturday or a Sunday trying to find the game, that's not good for the sport.
And if you're a kid who gets all of your television off of YouTube and you can't find it there, are you going to be the fan for those teams?
Exactly.
Seriously.
I think it's a real problem. It's not good for the sport at all, especially at a time when NFL is doing so well at the moment in this country.
Capitalize on it.
There you go.
Bring Taylor in.
Get Taylor in and do a special on Netflix. Is that what you'd like? Okay. All right. That annoys a lot of people, you know.
I do.
There's like two camps that don't care and other people who really do care.
Yeah, well,
very
Ray Dalio.
fired up about it.
Ray Dalio is a Swiftie, so. You know.
Didn't know that.
Yeah.
Mohammed Al-Arian too. We mentioned
he even
Mohammed.
thinks she can run for president, Ray Dalio.
Is that what Ray thinks?
Yeah, yeah.
Why? Does he actually think that?
She can bring a lot of people together from different walks of life.
Yeah, he said he'd be into it if she had the right people around her.
What does it say about the state of politics in this country that we're talking about pop stars uniting the country and running for office?
Exactly what it should say about 2024.
And not good. Up next on this programme, setting you up for the day ahead. You're watching Bloomberg Surveillance. Barry Knapp, thank you for the support. You and I share all the same problems, airports, where to watch football, and I even empathise with your hotel issues as well. Thank you, Barry. And for the other people that reached out in the last 10 minutes, all three of you, I appreciate it. Equities right now just about unchanged on the S&P 500, yields higher by a single basis point on a 10-year, 434.97. On our radar, about 40 minutes away from the opening bell, the data-dependent Fed.
We're not celebrating just yet. We try not to get too tied up with every single release because we do have more of a long-term view when we're providing our guidance. It's a step in the right direction. We have not changed our views. Yesterday's report, again, good news, but that's not getting us back to the 3-cut area right now. So we're still comfortable with 1 to 2 right now.
So here's the trading diary for the next 24 hours or so. Chipmaker Applied Materials reporting earnings after the closing bell. The Fed speak lineup is absolutely stacked. You'll hear from Barr, Barkin, Harker, Mester and Bostic ahead of Waller to round out the week going into the weekend. And Boeing holding its annual shareholder meeting at 11 a.m. tomorrow. If the regulator can't regulate Boeing, can the shareholder? We'll find out, I guess, a little bit in the next 24 hours. Bramo, final thoughts?
Well, just this idea of soft landing island, that seems to be the takeaway. My takeaway is nothing's changed from the economic data this week. So it really goes till next Wednesday and NVIDIA reporting earnings. That really becomes the next big stopping point at a time when a lot of people are looking at the shifting sands of technological shifts, et cetera, that might create something new that some of the economic data just really hasn't. This economy just keeps chugging along.
And there's lots of concerns around the economic data. Are people picking up the phones? And some of them, is it coming out on time? The revisions, look at PPI, how strong those revisions were. So when you look at potentially maybe what corporates are saying, Walmart this morning I thought was great. This is one of the biggest companies in the United States and showing that the higher end consumer is looking for deals. Inflation is biting everyone across the board. And that for me was the big point.
What do we think of Jamie in the last hour? What was your big takeaway from that one, Lisa?
He is the ultimate politician, even though he doesn't want to be in politics. I mean, this is essentially, he said he's not interested. But at a certain point, the corporate executives, to me, are becoming the new ambassadors for the United States in a way that a lot of politicians in the U.S. aren't. And I find that the most interesting in some of these international tours that we hear from a lot of chief executives.
Absolutely. We saw that in Davos. Remember, it was him behind the scenes with Zelensky having this catch up, him and a number of other executives. But what job, if he was a politician, would he applying for? Francine, of course, asked him about Treasury Secretary, which even in Washington, D.C.
State Department.
I was there last week, and his name was brought up again as someone who potentially be Treasury Secretary. But then he talks about nuclear blackmail, China not a natural enemy, talking about India. I felt like he was going over to the State Department, the Defense Secretary.
Take a pick.
Well, I think at this point, this is somebody who can have that sort of bird's eye view and will have that bird's eye view. There is this issue of who is going to fill the White House. And we talked about that with Libby, Cantrill. And I will just say that corridor between Washington, D.C. and New York has gotten very busy.
Yeah.
You can feel it as people try to kind of gun for different
I'm not
positions.
sure it's Wall Street. It's the court downtown. It's not Wall Street and DC in that corridor that's got
what you
busy.
think?
You come up here to kiss the ring.
Speaker
That's what's happened the
Johnson.
last couple of days.
Yeah.
Absolutely, yes.
It's quite the lineup.
Absolutely. Coming up tomorrow, here's your lineup tomorrow morning. Jeff Yu of BNY Mellon, Megan Robson of BNP Paribas, Mohammed Al-Erin of Queen's College, Cambridge, and Morgan Stanley's Seth Carpenter. All of that and more from New York City. Thanks for choosing Bloomberg TV. This was Bloomberg Surveillance.